Dzień dobry Państwu. Zaczynamy.
Good morning, ladies and gentlemen. We are ready to start. We apologize for a slight delay. Let's blame it for the chair, that is myself. Very soon we are going to have an official opening by the chairman of Polish Financial Supervision Authority and the professor. But first let me explain who are the organizers of the meeting. This is the European Financial Congress and the Office of KNF and IMF. And I was supposed to mention media patrons, and I do it with delight. Gazeta Prawna, my legal paper, is the main patron. On top of it, Bank PL and Bank Monthly and Forsal PL. And now let me turn the floor over to the chairman of KNF, Mr. Jacek Jastrzębski, who will officially open our event. Good morning, ladies and gentlemen. Let me welcome you in the adobe of the Financial Supervision Authority. Our moderator was gracious enough to take the blame for the delay, but we know what was the true reason. So let me try to accelerate, not to destroy the agenda. I would like to welcome the guests and co-organizers of this event. KNF is the host in terms of premises that were offered, but we are co-sharing it with the European Financial Congress and the International Monetary Fund. Let me thank Mr. Leszek Pawłowski, Professor Pawłowicz, and Mr. Carlos Granados, who is representative for our region, for taking initiative and joining us in this effort to organize the event. This year, we want to explore the investments in the capital market. As you know, these are the cyclical meetings, and we want to focus on the themes that seem to be particularly relevant for the financial market. And stimulating long-term investment seems to be one of the key priorities. I should say that that's the main focus of our interest for a number of reasons. Our economy is facing a major challenge since we need to raise funding for the energy transition process, and we have to provide substantial financial flow to support innovation in the economy, to be able to retain the growth trajectory of the Polish economy. As we know very well, the driving forces that were based on the competitive wage structure are actually becoming obsolete and come to the end, so we have to shift gear. And Łukasz Halt, my colleague, told me that we need to technically armor our work, and to be able to do that, we need to improve innovation in our economy. On top of it, we have a number of challenging investment projects, telecommunications, energy transition, you name it. And these are long-term projects that need a lot of capital expenditure. The financial sector usually plays a major role in providing funding for such projects, but we know that this is not an optimal approach to rely solely on banking lending efforts. Therefore, from our perspective, we see the need to have a better financing mix so that we do not have too heavy of exposure for the banking sector. And therefore, the financing mix have to be also based on the capital markets. That would supplement the engagement of the banking sector. And the flip side of that shows the challenges that arise due to the demographics, namely aging of the society. But it's not only about aging, it's also about things that are truly positive. For instance, longevity, expected lifespan is growing, which means that we have to put more thought into proper retirement options so that people who are of senior age and are not able or not willing to continue their professional engagement. And that actually takes us to the supply side of the capital. So there is many arguments in favor of this discussion. We need to provide financial cash flow to support investment project in the economy. On the other hand, we have to expand the market where people who are at the peak of professional careers, but also new entrants into the labor market, they should be able to find the adequate offering of the long-term saving products, including retirement pension products. So it seems that these two perspectives give us a good enough reason to take a closer look at this particular topic today. And we should think together how to make these two things happen. I agree that it's really hard to build a capital market that would meet our expectations and ambitions without engaging retirement savings. We know very well that other successful markets, US markets, but also other that are less far away from us, because we often look at the Swedish market, but there are other European markets that have a much greater financing of the capital markets in the economy. So in all these use cases, a major feature is using retirement saving to further develop the market. We have to look at it closely, otherwise it will be really difficult to build a long-term capital. I don't want to get into the details, but we had a number of the discussions already, such as how to mobilize private capital, how to engage pension funds or other saving institutions, or even private equity or other vehicles. I believe that all these things will be addressed during the discussion. And corporate governance is also an important aspect. If we want to encourage a lot of investors to take part in the capital market, we need to be mindful of that. I'm quite sure that these discussions will cover that today. Darek Adamski, my deputy, who's responsible for the supervision of the capital markets. Łukasz Hart, my advisor, who's responsible for macroeconomics and institutional economics, will be also engaged in the discussion. So without further ado, I would like to welcome you again and thank all the organizers of this event. I do hope that I outlined the logic that supports the idea and the topic of this seminar. Thank you so much. Thank you, Mr. Chairman. Would you like to add anything? Yes. I just wanted to add that Mr. Janusz Rywka will be speaking. He's our Director of the Financial Market Development Department. Thank you. So now we will hear another logic, perhaps different or perhaps very similar, from Professor Leszek Pawłowicz. I will invite Professor Pawłowicz to open the seminar on behalf of the European Financial Congress. Good morning, ladies and gentlemen. First of all, I would like to thank you for accepting our invitation, and let me thank the host, Professor Jastrzębski, for very meaningful cooperation. Obviously, sometimes our opinions may diverge, and I think that we will see some difference of opinion today. But nevertheless, we always strive for a constructive solution. That's why we hold the debates, and this is why we share opinions and expertise to come up with the meaningful solutions. To put it short, in my opinion, we don't face the problem of the shortage of capital. We just don't have a proper mechanism for the allocation of capital, because the allocation of capital through the banking sector is deficient, and the capital market allocation mechanism is almost non-existent. Later on, I may explain in detail what I mean, but this is just the main highlight of my thinking. Let me just say that today we have over 600 people who joined us online, in addition to everyone who's in the conference room. So let me welcome our online viewers who have the right to take part in the discussion, because this is the formula that we have for the meeting. The online participants are welcome. And on the final note of this short introduction, let me say that for all in-person participants, we have a tiny gift, a book, Profit and Principles. This is a book that we published last year. And this is a book which is recommended by former President Lech Wałęsa. In that book, he also extended his invitation to the outstanding authors and co-authors of that book. We will continue this publication. In June, we are going to have the second edition that will be expanded. It is on the way. So for everyone who attends in person, will receive a copy of the book. So when you, before you leave the conference, please pick up your copy. Hopefully you will be interested in reading, thinking and reflection of key opinion leaders, global key opinion leaders. My lectures would reach out to, 300 students at a time. But Professor Timothy Snyder, who was our guest, had 1.2 million viewers. So just to give you the sense of proportions. So we approach these key opinion leaders to co-author the second edition of our book. And the second edition will address the question, what can be done through the financial system to mitigate the risk of war. Thank you. Thank you, Professor. Right now, we are going to have a series of interventions. The first speaker is Mr. Carlos Granados, who's the representative of IMF for Central, Eastern, and Southern Europe.
Good morning, everyone, ladies and gentlemen, distinguished guests. Good morning and welcome to this event. We're very happy to be part of this initiative, and we want to thank the rest of the organizers for a fantastic gathering. Let me start by thanking all of you, those who made the seminar possible. To start with, Polish Financial Supervision Authority and the European Financial Congress, of course, for their cooperation and commitment to this discussion, which is very important indeed. I would also like to thank all of you in the room and all of you online, regulators, policymakers, investors, bankers, for taking the time to engage on an issue that is central to Poland's economic future. We're here to talk today, as we heard, about long-term investment, how to increase it, how to finance it, and how to ensure that savings are channeled in a way that supports innovation and sustainable growth. These are not abstract questions. These are very important, tangible questions. They go to the heart of how the Polish economy will perform over the next decade. I'd like to structure my remarks around three questions. The first is, what is the situation in this respect of Poland today? Then I'll move to talk about how it fits into the broader European and global context. And I will conclude my remarks talking about what this implies for policy going forward. Let me begin with a simple and important observation. Poland has been a major economic success story in the region, for the continent, and actually globally. Over the past 3 decades, Poland has achieved strong and resilient growth, avoided major crises, and steadily converged toward higher levels of income. What is particularly striking is that this growth has taken place with relatively low investment as a share of GDP, and with capital markets that remain small relative to the stage of development of this economy. And this is worth noting because it shows that there is no single model of growth. Sometimes you've heard that Poland's development path is compared to that of South Korea or other Asian or Latin American economies. But while some of those countries benefited from a stronger role of domestic private investment, Poland's convergence shows that strong growth can also happen in countries with shallow capital markets and lower domestic investment in comparative terms. As you know, a large part of Poland's success has been driven by FDI and open access to export markets. EU accession and FDI brought not only capital, but also technology, management know-how, access to global value chains, and productivity gains. This model worked extremely well, and we should acknowledge that clearly. But we also need to be honest. This phase may be reaching its limits. And there are challenges ahead that will require transitioning to a different growth model. One that is likely to require higher domestic private investment over a sustained period of time. Let me go through the key challenge that this economy is facing. First, the demographic challenge. The working age population is shrinking. Fewer workers mean that future growth cannot rely on growing labor force only. Instead, it must rely more on capital deepening and innovation. In other words, sustaining the current high growth rates will require a more capital-intensive economy than it has been in the past. Second, the energy transition. Decarbonization, energy security, and climate adaptation require very large investments. That is not a one-off effort. It is a multi-decade transformation, and it cannot happen only financed by the public sector alone. Third, and now this is very in fashion today to talk about this, the digital transformation. Incorporating new technologies, including AI, will require significant amounts of capital, as we are seeing in other countries around the world. And when thinking about investment and innovation, it's important to be aware of 2 different perspectives in the corporate financing landscape. Here in Poland, for large companies, access to finance is generally not a problem. Many large firms are sitting on significant cash buffers. We've heard that already, accumulated after years of high profitability. Many of these companies, they simply prefer to distribute those profits or deleverage. But when they decide to invest and borrow, they can obtain bank credit on good terms, quickly, and issue new equity in large global markets. But the situation is very different for small and medium-sized enterprises, particularly in countries like Poland. Many SMEs do not meet bank lending criteria, especially when projects involve innovation, intangibles, or higher risks. Yet these firms are precisely where much of the future growth potential lies. They need equity and risk capital and not just debt. This is where private equity and venture capital become crucial, and where Poland still has significant room to develop. It also must be noted that there is a lot of money in the system. Households have substantial savings, much of them sitting lazily in zero interest accounts. This is an inefficient allocation of resources. We heard the professor talk about allocation. The question, however, is not simply how to push households into higher risk investments. We should be very clear here. We do not want households to finance high-risk enterprises directly. What we need are strong intermediaries, private pension funds like Poland's PPK, and investment funds that can pool savings, diversify risk, and allocate capital efficiently. Households need these intermediaries to offer good saving products, cheap, diversified, transparent, and well-regulated. And savings should be invested where they generate the highest risk-adjusted returns, and not necessarily or not only on the Warsaw Stock Exchange. If governments try to direct household savings into certain development goals, risk-adjusted returns will suffer and participation in such vehicles will fall. And most importantly in this respect, we must confront the fact that investment incentives for Polish households are distorted. Real estate enjoys a privileged position in the tax system. This strongly biases savings towards property, often an illiquid asset which also significantly reduces the diversification of portfolios because of its large size. This is not healthy for long-term growth or for social cohesion. Now let me move to the second block of my remarks, talking about how Poland looks in a broader context. At first glance, the situation in much of advanced Europe looks very different from Poland. While Poland has been growing at above 3% in recent years, much of Western Europe has struggled to grow at a third of that pace. Poland is in a comfortable position, but it can be complacent, as the challenges faced by other European economies today are a preview of what Poland may face tomorrow. At the same time, the world around us is changing. Global trade is no longer expanding as smoothly as it once did. Trade barriers are emerging, supply chains are being rewired, and geopolitics have become more complex and uncertain. Strategic considerations increasingly shape economic decisions. This is why there is now broad recognition across Europe that the European economy needs to become more innovative and competitive overall. Fragmented capital markets and underdeveloped risk financing are seen as structural weaknesses for this goal. You probably followed the debate of the leaders just a couple of weeks ago. This has brought renewed focus on deepening the single market, including through the creation of a savings and investment union. This initiative aims at mobilizing about 10 trillion of European household savings, which are currently held in low-yield bank deposits to be invested in capital markets where potential returns could be higher. The saving and investment unions would encompass the entire EU financial system and be developed at both EU and national level. This comprehensive approach is designed to create a unified, well-regulated and integrated financial landscape across all EU member states. And now, I am aware that some of you may feel that Poland will not gain from this initiative. In particular, some may feel that Polish household savings will go abroad, or that Polish firms will fail to attract sufficient investment to grow. But here, I would argue that this is the wrong way to think about the whole process. First, on savings. Households will not get the highest risk-adjusted return by investing only in the domestic market. Look at successful funds in Scandinavia. There you won't see requirements to invest in the domestic market. And second, regarding companies. The Poland of today is not the Poland of yesterday. Poland's last 30 years show an extraordinary ability to adapt, integrate, and benefit from openness. The Polish economy is dynamic, entrepreneurial, and flexible, and it can compete with the best players in Europe. Poland, for example, has now over 3,500 startups and the region's largest share of companies classified as a scales-up. These are firms which have raised over 15 million euros each and are growing rapidly. The bottom line is that there are many companies in Poland ready to compete with high potential and to become eventually European champions, including those which are already major players like, for example, Impost or Allegro. My message in this respect is that deeper and more integrated European capital markets are not a threat to Poland by default. They can be an opportunity for Polish firms to access larger pools of capital and for Polish savers to achieve better diversification and returns. There is no reason to be reluctant to engage in this ambitious initiative. The key is to engage actively in building the Savings and Investment Union and to shape it in a way that works for Poland as well as for Europe. And now Poland is a major power in the European Union. So what does all this mean for policy? Let me finish my remarks by talking about this third block, focusing on policy priorities. First, policy priorities at home. Poland needs to build instruments that channel some savings out of zero-interest deposits and into productive investment. This means developing investment funds, long-term saving vehicles, and institutional investors that households trust. The proposed personal investment account, known as OKI, could help channel savings into capital markets. But we should be careful. Forcing a domestic saving bias is not the solution. Savings should be allocated efficiently, across borders if necessary. It also means introducing the right incentives. As I said before, households are currently overexposed to real estate relative to financial assets. At the same time, the fiscal deficit is large. In such an environment, why would Poland want to incentivize real estate with tax advantages? It distorts household behavior and locks capital into relatively unproductive assets. Introducing the right incentives is politically difficult, we know, but it's also economically necessary. Without it, efforts to deepen capital markets will have limited impact. And second, let me talk about policy priorities abroad. Polish authorities should engage actively and constructively with European partners in shaping the future of the single market, including initiatives such as the Saving and Investment Union. One of the things Poland could do is support an increase in the supervisory powers of ESMA. A deeper and more integrated European market can strengthen resilience, improve capital allocation, and ultimately support growth in Poland as well as across Europe. Let me conclude. Poland has done extremely well, even with relatively low investment and relatively shallow capital markets. But the conditions that supported past success are changing. Demographics, the energy transition, and a more uncertain global environment all point toward the need for higher, smarter, and better finance investment. This is not a task for a single institution. It requires cooperation between regulators, financial institutions, policymakers, and international partners. Exactly the kind of cooperation represented in this room today. Poland has repeatedly shown that it can turn integration into opportunity. Continued engagement at the European level can help ensure that the evolving framework works for Polish firms, Polish savers, and the Polish economy as a whole. I wish you a very fruitful seminar, and I very much look forward to this discussion. Thank you for the invite, and I hope the journey is productive. Thank you.
Analysis, for a starter, makes us feel like we are dealing with the most important thing here in Poland at the time. Teraz poproszę pana Dariusza.
Now I'd like to invite Dariusz Adamski, Vice Chair of the Financial Supervision Authority, to present our local supervisory perspective. Yes, and this perspective indeed is in line with the notion that this topic is very important economically. We don't have any doubts here in KNF, and I will give you a few more arguments to confirm why it is so important. Let me start by saying that probably some of you know how much the construction of Port Polska will cost. It's 43 billion zlotys, Polish port. In recent days, an agreement was signed between three big banks, and I'm very glad that I see the president of one of those banks here in the room. And this is for the financing of a little bit over 3 billion out of those 43 billion. And the gap, investment gap, is still large, naturally, because we talk about 3 billion only, and the total cost amount to 43 billion. So the question is, how do we find the financial resources for those investments? And the ideas differ. Maybe state budget, maybe resources from the Persian area, investments. But what about Polish capital market? How can we mobilize Polish capital market in this situation? And I think that it's quite unfortunate that we are not asking this key question. And I have my hypothesis about it. That so far our economic growth was built on the foreign capital. It was stable, it was supporting investments, it was not just portfolio or speculation capital, it was not destabilizing our economy. So now this way of thinking that the capital will come from outside and will finance big investments is quite natural. But the difference between now and the beginning of the 90s is that at that time there was no alternative because we did not have any local capital. Now, this local capital is accumulating. One thing is the resources on deposits, but it's also accumulating within the capital market because the assets of investment funds at the end of 2025 amounted to over 573 billion zlotys, and they grew by over 70 billion zlotys during 1 year. So the capital is really growing, but for some reason it cannot finance those investments, which are crucial for the further growth of our country. And this is a topic that concerns us because we see the role of KNF not only as a supervisory body in a traditional meaning, but also as an institution that should support the development of the market. And when it comes to supervision of capital market, releasing the resources which are less productive for everyone to invest them, we want to help to invest them in a more productive way, and this is the priority of KNF when it comes to the capital market for this year. Chairman Jastrzębski also mentioned that our retirement products are really crucial. I usually mention that I am not very happy that at the moment we have the inflow into the share funds, because this is maybe not the best moment. Because when it comes to products, short-term products, people have a tendency to pay money at a wrong time and then pay out the money at the wrong moment. But the problem does not exist with retirement products because they are usually long-term and they also support economic growth and they perform better in general for investors. So the first issue that is very important for us is to properly use the review of the PPK funds that is now ongoing, and we think that it's justified that PPK funds, which are not classic retirement products, they might get this retirement character, so that they should not be short-term instruments of storing the finances. They should be classic third pillar retirement products with all their consequences. Another issue is IKSE, which is another product similar to PPK, which is very popular, but despite ongoing progress, this is just a program for the richest people, and retirement poverty is a risk that affects other segments. So each modification of the IKSE program that could modify it would be really beneficial for this program and for the economy, and also for the participants. It's been over 10 years since the changes in our open retirement funds. It was a topic of taboo for a while, but it's also the area that requires certain adjustments, because we see that in several years those open retirement funds will have a negative impact on the stock market and also the prices of the stocks of companies which are listed. And it can also have impact on the PPK program, which we should all support. There are ways to solve this negative impact, and we hope that we can also discuss it with the decision makers. And legislative changes in the Act on Investment Funds that are planned in the nearest future it's not only those related with ETFs, but also ones which are to create like an investment time machine on the capital market in the form of a qualified investment fund. And this also fits in this logic, because we, as an office, support all activities that promote the creation of those funds. Because in Poland, we still do not have infrastructural private market funds. This is quite a surprising situation. But we also know that once those instruments appear, and we also already have Innovate program, there is a lot of interest in the creation of such funds. They're crucial because the individual investors should not really invest in non-liquid capital market assets, but the institutions that provide products for those investors, and then competent, qualified people in those institutions will be investing on behalf of people, and that would be a structure of a well-working market. Another topic goes beyond the mandate of our commission, our office, but it's also worth mentioning the role of the innovation policy. This is not an aspect that was traditionally well developed, and it was not the focus of decision makers, but without a well-functioning innovation policy, there will not be a good, strong capital market, because capital market always provides financing for companies which generate higher business risk, but at the same time, they have larger potential for return. And these are usually innovative enterprises. So the more of such innovative companies we have, the better it is for the market. Not only for the private market, which usually finances the development of such companies at earlier stages, but also for public markets, because more mature enterprises usually drive the public market. There is also another topic going even more beyond our mandate, but it also fits into creating good conditions for the growth of capital markets. And this is the topic of the state control over economic entities, and some reflection that is currently taking place in the Ministry of State Assets. But I think maybe the scope of this activity is a bit too broad. We know that private equity has the advantage because it provides more corporate hygiene, to put it that way. I think that at this stage, the innovation policy would be more crucial for the development of long-term productive investments. But it's always good to remember about this corporate hygiene, which can be more valuable than what Carlos mentioned a moment ago. So striving at mechanical support for the local markets. We've just finished consultations about the act about OKI. And we were discussing the options of tax relief, and the requirement is the 70% of local assets. And it's not because we don't want to develop our local market, but we think that there are better methods to support the local markets than complicated solutions which work well in other countries because they are simple, like, for example, in Sweden. So we focus on those things. And another thing is creating instruments, financial instruments, which are available. And in our opinion, this plays also a crucial role. Some of those instruments, such as qualified investment fund or retirement products, these are instruments that are being developed. But also other instruments could serve this purpose. The lack of REIT funds in Poland, and because of this, a lot of investors do not have options for investments. It doesn't mean that there are no investments, but they are only for certain other categories of entities. So we want to increase the scope of potential instruments, such as the rights. And I have no doubt that we can shape the regulatory environment to avoid certain complications, and we are able to create instruments which will be productive and will not generate any negative impact. Thank you very much.
Bardzo dziękuję. Mamy zatem przegląd tego, czym Komisja Nadzoru Finansowego.
Thank you. We do have an overview of what Financial Supervision Authority is really focusing on in terms of the capital markets. And now I would like to invite Professor Pawłowicz. His first intervention was a welcome speech, and it was very gracious and nice. Let's see what is the second intervention about, if it's going to be equally gentle. Well, I think that it was a strange invitation. You implied that it's not going to be nice, what I'm going to say. But I've been retired for 4 years, and therefore I've been looking at the developments from a certain distance. I'm looking back 50 years, and I have to say that things were similar. Just the joyrides from success to success. I attended conference yesterday, today. Even our colleague from IMF said that it's a story of success. But 50 years ago, the Communist Party leader, Edward Gierek, was telling us that we are number 10 economy in the world. Today, we barely made it to G20. Is it a true measure of success? Obviously, I'm joking right now, but I remember that time. It was 1976, and we had issues with public finances because the Communist Party leader decided to borrow more and more internationally, and Jacek Fedorowicz, who was one of the opposition leaders, and Jerzy Urban, who was one of the Communist Party official and the head of the propaganda, was making jokes about it. But, well, this is the story from 50 years ago. And since at that time I was 24, today I'm much older, but at that time, when I listened to that propaganda, I was amused. Today, I am amused too. What success! Look at the Warsaw Stock Exchange. The capitalization of Polish capital market is 21% of Polish GDP. Come on, what other country would have it at such a low level? And we are one of the first post-communist countries back in 1981 that launched the capital market. We were very proud. We were improving our stock exchange on an ongoing basis. I think that back in 2007, we set up the additional markets, New Connect, and then catalysts for the bonds, so sub-markets, and then nothing happened. More and more publicly listed companies were shifting back to the government. So looks like we are sliding back to a centrally planned economy. And when I look at the capital market, I don't really see much of success. I should say that it's a failure. If you compare us to other countries that are fairly similar in terms of the structure, for instance, take France. There is a lot of government control over the economy. This is not a liberal approach. Or other economies that combine the market mechanism with interventionism. In France, if I recall properly, the stock exchange is 117% of French GDP. And yesterday I looked up the Polish stock exchange, and it's 21% of GDP. So it's not much of the success story. And the role of the capital market as the capital allocation mechanism is very poor. And what we were trying to do with the New Connect floor, which is now called Innovation Program, well, that was the program geared to support startups and other companies that were not able to make it to the main floor, and therefore they were listed on the New Connect, where the requirements were less stringent. Now, when I look at the second leg of the capital allocation in Poland, and this is the banking sector, I can tell that it has been growing all the way. And again, another success story, you may say. But when I look at the capital allocation mechanism, and when I look at the total savings to total lending is 61%. So it has never been that bad. In Germany, it's 121, so they have more lending than whatever they collect in deposits. But in Poland, on average, we were usually hovering at 100%. I'm looking at Mr. Mazur, but I think that 12 or 14 years ago, we were still at 100% savings to lending. Today, it's just 60%, so it means that the vast majority of local savings are idle, not used. And there are many reasons for over-liquidity in the system. But all is placed in one pool, supervised by National Bank of Poland. It's over 400 billion savings, and the treasury bills account for the majority of it. Treasury bills are issued by NBP, and then the mandatory reserve that it's also a vast chunk, and the National Bank of Poland pays 4% on it. This is the reference rate. So this is kind of funny. This is like, stopping at the red light because you are required by law. As a bank, you have to contribute to the mandatory reserve. This is not optional. This is the mandatory thing. And let's say that the police officer is approaching you and saying, look, you stopped at the red light and therefore you are eligible for the award, 1,000 zlotys. So this is like the whole mechanism of the mandatory reserves. The bank is supposed to keep the mandatory reserve, so the reward is 4% interest on that. On top of it, there is over 400 billion, like 460 or 480 billion zlotys in savings that are parked or are sitting with at the National Bank of Poland. And obviously this money could be channeled to the capital market, but it's not going to be channeled anytime soon, because no one has an idea how to approach that. There are no instruments on the capital market that would have capacity to absorb such savings. One of the ideas that we had 200 years ago was mortgage bonds. But after 200 years, the first issue to retail investors on the 30th of November last year, the PKO BP Mortgage Bank sold 1.1 billion mortgage bonds. But this is peanuts. We are speaking about 460, 480 billion of idle savings. And we were able to absorb 1.1 billion out of that. And this is a success that the mortgage bank scored. But from the point of view of the macro mechanism, that's a very tiny success. The overall mortgage bond market is a super safe segment of the capital market where you can invest your savings. Doesn't matter whether you go through the financial institutions as intermediaries or whether you engage directly as an individual investor, retail investor. This market is several hundred times smaller in Poland compared to the countries like Germany, France, or Denmark. And if you take Denmark, you see that all the mortgage loans are actually funded through the issue of mortgage bonds. There is no other way to fund it, and they don't have a problem with prepayment. You buy mortgage bonds, you go to the bank, and that's it. You go to another competitive bond that may decide to lend me money so that I can buy the mortgage bonds at the price. Everything is smooth, but most likely this is the only country in the world that has such a system. I truly like the system, but in the European Union, if you look at the mortgage bonds, they account for 25% of funding of mortgage loans. In Poland, we have approximately 500 billion zlotys in mortgages. If we wanted to be on par with the EU average, we should have at least 125 billion zlotys in mortgage bonds. So to me, that's a doubtful success story. But perhaps it would be worthwhile to consider other instruments on the capital market that are better aligned with our current situation and are better aligned with our mindset and overall culture in Poland. So I was trying to figure out what could be a good solution. What would be successful in terms of meeting the demand. I remember that in case of this issuance of mortgage bonds, I think that they wanted to close the process within 3 weeks, but they were able to sell everything within 3 days. Demand was much greater than expected because people actually were happy to embrace it. Myself, I actually bought quite a large chunk of those mortgage bonds. Now, we see a number of challenges arising. And when I look at this deficient capital allocation mechanism that we have in Poland, I really feel the urge to suggest why not to issue project bonds. We have investment project bonds, whether this is motorways or transmission grid. Perhaps this is not the instrument that is as popular as mortgage bonds, but this is something that would probably fit the current situation in terms of the transformation and our defense spending and digitization. I believe that these projects could be funded through the issue of bonds. Obviously, those who directly invest in these projects get the return. But there are some other projects that are more of the public good, like the motorway network in the country or transmission grid. In Germany in 2012, they were issuing project bonds under private-public partnership, where the state treasury was making an in-kind contribution in the form of the assets, buildings or some properties. I think that this is an opportunity that was never truly grabbed. We used to have a transformation process in the economy. Look at the former state-owned farms. I think that you don't remember these farms because you were not born then, but I think that in 1995 they shut down the last government-owned farm. So they set up the government agency, now it's called the Agriculture Support Center. But the privatization process was completed. Today, you can only lease the land which is owned by the state. Perhaps it's good, but again, to me, it is way too close to the centrally planned economy concept. And on top of it, when I look at the land which is held by the Polish railway, the railway stations that are held by the Polish railways, but the land around it is usually the property of the state. And again, that could be the in-kind contribution to the project to secure the project bonds. Because if the project bonds are properly secured, we have two benefits. First of all, they provide cheaper financing, cheaper by 40% on average. And on top of it, such bonds are much more attractive as a saving instrument. Because savers, who are the bondholders of the SPV that was established based on these assets that were contributed by the state. Doesn't matter what kind of assets. I don't want to get into details, but it could be equities, it could be stock in the companies. the Minister of State Assets has over 200 companies in their portfolio, including some confectionery businesses or bakery businesses. They don't really need to have to be held in the state hands. And then the military asset agency, they have a pile of assets. Again, these assets sit idle. And now let me revisit what I said at the beginning. To me, it's not the right definition of the problem. We don't have an issue with the lack of savings. Because if we actually have the individual investment account and 100,000 zlotys will be exempted from the capital gain tax if invested through this account, that's fine. But then you need to have some instruments to invest in. Because as I said, it's not true that we have lack of capital. In truth, we have a surplus of capital that is sitting idle. We have the surplus of assets that are sitting idle. Now I'm looking at the former governor of the central bank. Look, we have the foreign exchange reserves, and they are way inflated. This is over 1 billion zlotys if you take the exchange rate from yesterday. Now, would you say that the economic risks that we are facing are so high that we need to have the highest foreign exchange reserve in Europe? We have 27% of GDP in our reserve. The average for the EU is 20%. The UK has it at 5%. So perhaps it would make sense to sort of spend some of these reserves on our military spending.
Czy finansowanie
Whether it's financing the national production or buying new equipment, it doesn't matter, but leveling the risk of war these days by creating this safety buffer, which is larger, I think it's much more important than securing us from economic risk by using those foreign currency resources. So I wanted to mention those savings that lay idle that could be transferred to capital markets if we have a good idea for that. Those state assets which are also idle and we don't really know what they are for. And the third thing is those foreign currency reserves which are so large, and that's what I wanted to say. I don't want to bore you. I'm sorry if I may be too skeptical. And I'm not only speaking about success and everything being positive. I just wanted to motivate others to maybe discuss and argue with my views. Thank you. Thank you. No, the spirit was right, you know. It was the introductory speech for the first debate in which the professor will also participate. And apart from that, I would like to invite Mr. Ludwik Kotecki. I see that you made it. You are here with us. Marcin Mrowiec, Chief Economist from Grant Thornton. Wojciech Papierak, who was already praised, the president of the management board of PKO Mortgage Bank. Professor Pawłowicz and Andrzej Raczko, advisor to the president of the National Bank of Poland. We talked on the phone a few days ago, and he promised that he would be speaking on his own behalf and not on behalf of the bank. Please take your seats. Dear professors, just some information, especially for those who are watching us online. You should see information there that you can add comments, ask questions through the use of Slido. And dear professor, you might be surprised by it. I already saw one question during your presentation. You were saying that our stock market is so small in relation to our GDP, and in France it's way over 100% of GDP. France, that is not very famous for their capital market. So the question was, what was the capitalization of the stock market in France to GDP in similar countries like 30 years after the war or during the period of dynamic growth? Maybe we will not answer this question, but it's just a comment that shows us that we should look at it in a relative way to adapt the measures to the period that we are evaluating. We will be talking about the relation of long-term savings to economic growth. I was trying to plan a bit what we will be discussing. We will ask Mr. Papierak in a minute for sharing his experiences related with issuing of the mortgage bonds. But I would like to organize the discussion into 3 blocks. Firstly, what is our problem related with investments when it comes to our economy? The second part is about the savings, whether we do not have enough of them or too much, but the professor actually spoiled this part because he already answered this question, but we can discuss their structure. So we will see what you can say about this, and then the capital market. How can we make it more flexible, how more available? What instruments can we use? The first thing, and the question is to all of you, how do you evaluate it? The number of our investments, do we have too few of them? The rate of investments, is it too low in our country? Okay, so the economist, Professor Ryzyko. Well, they used to tell me that if you ask the economists in a public forum whether it's yes or no, then the correct answer is it depends. And when I was talking to you before, I looked at the statistics, and everyone is looking at it. We are convinced that the accumulation rate fell from 21%, which was already perceived as low. It fell to below 18%. Everyone is concerned about it. And then there's a discussion about capital market, and it concentrates on this. But if we look at the pace of GDP growth, then during the 10-year period when there was a drop of the accumulator rate, it turns out that GDP grew by 40%. So it's not that bad. Why is it not so good and not so bad? Well, there are two things. First of all, as economists, we know and we always ask if we are not happy with the rate, why is that? Is it that people are less eager to invest, or maybe the supply of the savings are too low? So the professor already said who is to blame. But I would like to take a broader perspective on this. We will all agree that the financial sector is for the economy and not the other way around. So, solving this dilemma, why the accumulation rate is low and we have a high rate of economic growth. If someone is an old macroeconomist like me, you probably remember the Kalecki formula that we used to have that was relating the accumulation rate with the other part, and we can quickly say that we have low rate of accumulation and quite high GDP growth because the capital intensity ratio is as it is. And what is the structure of Polish economy? This is probably the data that you all know. The Polish Statistical Office says that the companies that hire up to 90%, we have 2.3 million of such companies, and they employ 4,400,000 employees, so statistically around 2 employees for one company. Then we have mini enterprises. There are 50,000 of them, and they employ around 1 million people, so around 20 employees per company. And then we have, let's say, the real companies, medium-sized, which hire between 50 and 250 employees. There are 14,000 of them, and they hire around 1.5 million people. That is around 100 employees per company. And then we have large companies, only 4,000 of them, and they hire 3.3 million employees. So the answer is quite simple. With such a structure of economy, if we even include those small companies, then the capital intensity is at the level of 0. Because they are not investing, even though we as economists, we know that they use certain assets which can be understood that way. But why am I speaking about it? Because for you as financial expert, it's important which instrument should be used. So the answer is we should take into account the economic structure, because for each of those segments that I mentioned, there are different instruments which are necessary for them to help them invest. If we don't take that into consideration, then we will not move forward with investments. The statistics is also interesting, as is the structure of investments. Capital intensity is mainly related with constructions. The equipment, machines are less intense, capital intensive. But if we look at the structure and the ownership, this investment rate in construction is the largest in public sector, and it's much lower in the commercial sector. That also gives us the answer. If the share of those sectors are changing, how should those financial instruments also change? So we know the economic structure. Let's go back to my first question. Is it because of the reluctancy to invest or not enough savings? If we look through the lens of the banking sector, the answer is clear. Why? Because the so-called gap between the deposits and loans of companies amounts to 30% of the value of the loans at the moment. If we look at another ratio, what is the share of the loan without BGK and so-called commercial loans between companies, but I mean between financial sector and companies, the ratio between 2019 and 2025 dropped from 46% to 31%. So you can see, when it comes to willingness to invest, looking through the information in banking sector has declined dramatically. Why is that? This can be solved in a simple way, and my colleagues from National Bank of Poland made a simulation. So we take the share of the loans, and in order to analyze it properly, they took the share of the loans to GDP, and they divided it into a real growth and a deflation rate. And this share to nominal GDP was related with the deflation. So this big wave of inflation that we were observing in our economy, it really had negative impact on the financial sector, and we cannot forget about it. And we can see that negative impact because the share in banking sector of the instruments of the state treasury, and what the state treasury also guarantees on top of that is only 26%. So the situation is as follows. The loan could not follow the inflation, and it's because there were a lot of financial shields which were pushing finances into the economy. And at the moment, most companies can get financing not from loans, but from their own capital. So you answered even one of my next questions. But let me go back to the first one, because Mr. Mrowiec wanted to comment. Yes, I'm glad because you already mentioned a lot of statistics for me. But I wanted to continue this topic because I think it's crucial when we try to find an answer to the question whether investments are too large, too small. We were all part of this process of complaining about the level of investments, but let's look at our economic growth compared to other countries, to the region. And how do we solve this puzzle? Well, it's not so easy to reach the precise data. But I think we all have the same intuition, supported by numbers, that it's about the structure. And now I think that the problem of our economy is that the companies, that we have a lot of small companies, and the statistics that you showed prove it. And if we move backwards historically, we can create this hypothesis that when investments, real investments, were starting at the late 90s, beginning of the year 2000, the capital was so weak that it could not compete with large companies that were entering the market, that took a large share in the market. And talking about the statistics, various sources give various information, but generally, if we look at the structure of export from Poland, because we are glad that the export is growing, it is, but over 60% of export from Poland is the export of foreign companies who came to Poland and who are exporting thanks to us. Those companies, these are 33% companies, but they have 60% of the share in export. So the share of Polish companies is very limited. And the fragmentation of those Polish companies is responsible of the low level of investments. We have underrepresentation of small companies between 10 and 49 people. And we have a structural problem. Those companies were benefiting from cheap employees, cheap workforce, but it's not the case anymore. And they also don't have the critical mass to be able to build investments that we expect. And a question that I will leave you with, what can we do? How can we help them? In my opinion, we should help them look for new niches, new sectors. We talk about the development of AI, where Poland wants to also develop. We want the European Space Agency to have their office in Poland. We have a big representation of companies that work in this area. I was surprised to find this out. And we have SAFE program, which is related with dual use technologies, and I think that we should have complete deregulation here, and we should allow those companies to operate and to use our experience and talents that we have here in Poland. And another remark, the answer to the question of Mr. Pawłowicz from the point of view of the banking sector. I remember from my previous workplace in the bank, which was the biggest corporate bank at that time, the rates were very low, and we were wondering how to give more loans to companies. Physically, there were no projects that would fulfill the conditions that that they should fulfill now these days, you know. Okay, and the question to Mr. Kotecki about the same thing. About the investments and financing. Maybe the answer is clear, but I would be interested to hear your answer. About the financing of investments and investments in general, do we not have enough of them because we have... Do we lack money for investments? Is it difficult to get financing, or the investments do not need external financing, external meaning from the financial sector? Because, as we said, companies have quite a lot of surplus in terms of their own assets. We have funds from the EU, and I think we are really used to it. So we cannot imagine how it would be without this money. And we are talking about investments as investments of companies, but large part of them are public investments. Of course, companies are involved here, but it doesn't mean that a particular company increases their potential. I did not really check the data, but I was looking the day before yesterday at the proportion of private investments compared to GDP, and we are competing with Cyprus there. I mean, competing for the last rank. Yes, a lot of topics again, so one by one. Generally, I would agree with the previous speakers, but of course, there has to be a but. The structure of our economy has not changed that much, and still, and the investment rate has dropped, so there must be something different. Marcin said at the end about the interest rates. We talk about demand and supply, but we also need to look at the price. So this is the moment when I think, or within the last years, the interest rates were playing a really crucial role because they were increased. We know why, but the price of money was also high. Yes, well, it's not that the problem with investments has become problematic during the last 2-3 years. Yes, that's what I'm saying. We did not decrease the size of companies during last years. They've always been the same, more or less, but they were investing more. So the rate of investment, 21-22%. We had this level some time ago, and now it's at the level of 17%. So there is some gap, some change. And maybe another topic to have a full picture, it's about how we measure those investments. They are measured by the Polish Statistical Office, and this is another element that we need to be aware of. It's easy to measure, a machine or a car, but not investments, which are not so easy to measure, and to be sure whether it was actually investment or not. So there is some gray area here that that maybe there are some investments which we are not aware of, and maybe 17% is actually 18%. And going back to your question, we have this structure which is suboptimal, in my opinion, public versus private. As you said, we are competing, as you said, when it comes to private investments, we compete with Cyprus, but on the other side, when it comes to public investments, I think that we are one of the leaders. We are close to the top, if I remember the statistics correctly. So the rate of public investments was one of the highest in the EU. Why was it so? We had the resources that you mentioned. So the EU money, that was easy to obtain. And another thing, to answer your question, is about the structure of financing investments in Poland. It's not that only a banking loan is the source of financing. We have a big share of private owned capital. We have big share of public funding, and we also have big share of foreign financing. That is the companies with shares abroad, they take loans abroad, not in Poland. And 1/3, as far as I remember, of this financing comes from Polish banks. So 35%. So 66 or 65% comes from other sources. So in my opinion, it's not a problem of savings, but on the supply side of investments and maybe the price. But as we know, since May 2025, the price is being lowered gradually. I'm talking about interest rates. So it seems to me that those investments will start to grow, but starting at this low level. I'm talking about private investments, because public investments are not a problem, because we have the programs that you mentioned.
I was asking this question because since we are doing okay financing such investment projects, why to bother and talk about the financial markets? Mr. Brawiec, just one more thing. Investment rate was declining. It's a fact. But I think that you may try to explain that looking at the service sector. Now, we have a lot of international companies coming to Poland, setting up their shared services center. They hire a lot of people. They offer good wage that fuels consumption, etc. So this is part of the explanation, but it really shows the core of our problem. So we have productivity in the companies that are owned by international players, and the same is true for shared service centers. Perhaps we should somehow address that and do something about it. So now let me ask Professor Pawłowicz. My question is about defense spending, but viewed as an investment opportunity. So what would be the role of the capital market? You pointed out to the foreign exchange reserve, but some of these reserves should be released to pay for our defense spending. Professor, can you elaborate? I promise to be brief. And I just say that it's impossible. Why? Because first of all, you have to keep the balance sheet of the central bank at the back of your head. So assets keep creeping up because all the foreign currency that the government receives goes to the central bank to exchange them. So that's how we are actually inflating our foreign exchange reserves. Now, when you speak about foreign exchange reserves, I think that our colleague from IMF could really correct us with the definition. First of all, here we speak about the investments that are made by non-residents. So these are securities held by non-residents. On top of it, they are denominated in the currencies that are considered to be foreign exchange reserve currencies. And on top of it, high liquidity. Obviously, the purpose of the foreign exchange reserve is to keep your exchange rate stable. Today, given the fluctuation of the exchange rate, the reserves sit where they sit. But remember, you don't need the reserves when the market is quiet. You need the reserves when the gigantic crisis hits you. And it may hit you. It could be an external crisis that has nothing to do with you. And, we tested one scenario within the central bank, namely, can you have a substitute for the foreign exchange reserves? And can you keep the lower reserves as a result? And our colleagues from IMF remember, credit line was the first test. So the sort of flexible credit line that was offered to the National Bank of Poland during the previous crisis. And it was non-conditional, mind you. That was very characteristic feature of that credit line, and it was a substitute of the reserve. So we were holding the supply of currency, which was not foreign exchange reserve, but it was supporting our foreign exchange reserves. And on top of it, if you look at the large central banks, they have small reserves because, if needed, they just make a phone call and they have a swap line. And so you can actually have a swap on dollar to support the pound, or you can do the same thing with euro. So if there is any change in the policy of the central bank, well, you need to have such instruments at hand. No other way to go about it. Now, you need to look at the legal aspects. And the legal aspects are quite clear. We are part of the European Union system for central banks, and there are limitations. If you want to buy securities from the public sector, you face limitations. You cannot do it directly. This is a major hurdle. It may seem weird, but the Polish constitution is less stringent because the Polish constitution tells you that you cannot finance the deficit, the budgetary deficit through the central bank. So the problem will become important when we join the Eurozone, because once we are within the Eurozone, you have no need for the currency interventions because we would have the same exchange rate for euro. So it would be a completely different story. And therefore, the whole discussion about foreign exchange reserves, I think that Mr. Belka was the first governor of the central bank that raised that topic, and he was showing it in the context of our membership in the Eurozone. Well, I understand. You explained the implications of being within the Eurozone, and the implications for security, etc. But technically speaking, prior to this conference, we had another discussion with a group of people here, and we were really talking about gold. Namely, would it be a better option to buy some iron in the form of battle tanks instead of investing in gold? Perhaps Mr. Kotecki will cast some light on that. I think that it's not possible to swap gold for tanks because reserves have to be, central bank reserves have to be invested safely because they have to be treated as security as itself. And now the question is, when do you have too much reserve? This is not obvious. You can have a number of measures here that you can try to use, like multiple of export value or some other multiples or some other metrics. But you will always have to use your judgment here. Now, in Poland, you don't have a legal option to invest your foreign exchange reserves in anything else but financial assets or gold that can be safe haven, so to speak. And in our legal system, there is no one who could make such a decision. Is it the management of the central bank that should say that we have too much in reserve? Because mind you, this is not the central bank's reserve. This is the reserve of the state of Poland. And who's the owner of the central bank? It belongs to Glapiński or no. Yeah, it belongs to the state. But from the legal point of view, the foreign exchange reserve belongs to the entity called the central bank. I think that it was established years ago by the Supreme Court. Well, that was supposed to be a short side comment. I don't want to make it the core of our discussion. Now, another question popped up. Perhaps it's a good idea to increase the scale of investment through the mortgage bonds. And let me ask Mr. Papierak to answer this question. Thank you for this question. Look, I've been sitting here and I feel shy. I'm not a macroeconomist. I'm not even an economist. But on the other hand, no one sold 1 billion zlotys in mortgage bonds in Poland. True, but I'm not a marketing person either. So let me stick to the facts. And I have to say that I feel really squeezed when I sit in here, because I sit at the conference room of the regulatory authority, and this regulatory authority has 100% decision-making over how we can operate. I'm looking into the eyes of my owners, and on top of it, I feel the burden of savings deposited by Professor Pawłowicz in my bank. So that's not an easy thing to do. But to cast more light on the mortgage bonds, let me say that the most recent history of mortgage bonds, it has been last 20 years. And we can identify several phases over this time span. Myself, I've been engaged in mortgage bonds for 2 years. And when I look back 20 years, I can tell growth spikes. In 2019, it came to the standstill. Since 2019, we had a decline. And last year, we had the settle effect, and we started to bounce back. So what happened over the last 2 or 3 years? So, if I may, I would like to offer a broader context. Throughout my professional life, I continue to face the challenge of misalignment and mismatch between assets and liabilities. It's been the story like that since ages, that long-term assets are funded with the short-term liabilities. There were various approaches, various ideas, various instruments. So the market was coming up with a number of ideas, but nothing really worked out. And eventually, a few years ago, there was an administrative decision made. The long-term financing requirements were implemented to force banks to restructure or to change the structure of their balance sheets. And in my opinion, that was the main trigger for the last year developments. I agree with Professor Pawłowicz that the scale of operations of the mortgage banks in Poland and the scale of mortgage bond issuance is embarrassing. We have much greater capacity. But last year, as I said, we started to bounce back. And we decided to come up with the issue of bonds to the retail investors. You meet at various groups and teams, and you've heard those discussions. Perhaps it will be successful, or it will not be successful. We'll see. As a group, we were saying that this is an experiment that we have to run. And the experiment was successful. So let's take further steps to have the ripple effect of this first success that we scored. And that's our plan. But probably all of you realize that there is a proposal to change the regulation on long-term financing requirements. In my opinion, if this proposal is supported, it will be counterproductive. And I dare to say that because I speak on behalf of the entire micro segment of mortgage banks. So we have just started to take up speed, and you want us to pull the brake right away. We place mortgage bonds on two markets, domestic and international. International market is vast. There is no limit. There are like 3 billion euro in turnover. And the Polish market is like 5 billion euro. So that's the difference. So whatever we place on the international market, we can sell it. The last euro-denominated issue was closed within 90 minutes with a 100% oversubscription. So to us, it was a success. 500 million euros sold instantaneously to the commercial banks, to the investment funds, to different players. Now, the second market is our local domestic market. And here we have institutional customers and retail customers. On the institutional retail customers, it's just us. We had one issue for retail investors. And we want to repeat that. And whenever I can, I always encourage other mortgage banks to follow our footsteps. We don't take you as our competitors. There is enough room for all of us. We can do it for the benefit of the capital market, because this is a financial instrument. It has been said here, but let me highlight that. This is the only financial instrument that is financing investment in housing on a 1-to-1 ratio. Banks are slowly extinguishing their commercial portfolios of mortgages because of the lack of stability and valuation differences that affects their balance sheets and overall performance. So perhaps mortgage bonds are a good idea to boost the investments and the scale. That's the question. I believe that this is a good idea. I believe that this is a very good instrument, the safest ever conceived. I think that this is safer than the treasury bonds. Like historical experience from Greece and Portuguese corroborate my point. But it's not enough. At the end of the day, you have simple arithmetics. If the banking sector decides that it makes no financial sense for them to provide loans funded with the mortgage bonds, they will not do it. So you can replace that with some administrative decisions, some preferences, etc. That was the decision about the long-term financing requirement, and it still works. But now the hearsay is that they are going to pull it back. So again, we may face stagnation with mortgage bonds, but nevertheless, we will try to develop the market for retail investors. So on the final note, let me say that our plan is 10 billion zlotys in mortgage bonds over the course of 3 years. and we know that we have full capacity to do it. Thank you.
Experiment.
Let me just say that after the continuation of this experiment, it's important to be systematic. I think there is no other such systematic issuer as the Ministry of Finance. And when it comes to retail bonds, for just physical persons, they have 180 billion at the moment. When it comes to the scale of insecurity, it's proven by the fact that we haven't issued anything in mortgage bonds this year yet. It shows how important it is to have stable conditions in which we function. Is there an idea to change something? Well, we don't know what is the final proposal. The one we saw is not good information from the point of view of banks, and it does not encourage, for example, mothers to increase the scale of the issuing. That doesn't encourage banks to issue. So until 13th of February, nothing, no mortgage bonds were issued. And for us, it's very important to be systematic, to be consistent. Mr. Pawłowicz, I just wanted to add that indeed the topic of the mortgage bonds has been strongly neglected when it comes to capital markets, and it could be an attractive instrument for safe investment of savings. And on a long term, it could also contribute to lowering the interest rates of the mortgages. This is how it works. And 2 years ago, at the initiative of the Financial Supervisory Authority, certain working groups were created. One working group had a goal of forcing banks to prolong the liabilities, so that to force them to issue mortgage bonds and to replace short-term deposits with them. Or also the current accounts, which are the basis of financing of 30-40-year loans. So this is the structure of a mismatch of the maturity dates in the Polish banking system. So for me, those steps are quite obvious to me, because no commercial bank will want to obtain the liabilities at a more expensive price if they have the permission from the from the KNF to finance 30-40-year loans with the contribution. So if we allow the moral hazard, so to say, moral gambling, those who do not want to participate are going to lose, because their competitive position will be worse than the one of those who are ready to prolong those, extend those liabilities. Another team was a working group that was working on institutional domestic market of the mortgage bonds, and a third group was working on the retail domestic market of the mortgage bonds, and none of them got the approval of the banks. We created this ratio that forced the extension, the prolonging of the liabilities. And of course, the restrictions were lowered from the point of view of the banking supervision, and that would be allowing this moral gambling for me, and I would not share this opinion. There is some discussion, but I don't believe that banking supervision could decrease the restrictions within this area. because it's already relatively low. And those mortgage bonds, we have those 5 issuers because there are only 5 mortgage banks in Poland. This is not much. The BGK Bank could also participate. They have the license to issue mortgage bonds. So it would be good if they used this right in some larger system that would be related with macroeconomic stability, but they're not doing that yet. And what I was also suggesting, possibility to think of some project bonds, let's say covered bonds, because there's an ongoing discussion now in Europe about the single cover bonds market. I think it's not going to lead to any good situation, but there is such discussion. And I think that it would be kind of a substitute or complement to the market of a mortgage bond as a form of attractive instrument for the savings, which is safe for the people, because in deposits we have some protection here. We could also have another security instruments, and people who don't like risk would be willing to allocate their money on the capital market. But now they don't have these opportunities because it's like an empty group of the safe instruments, long-term project bonds. If we look at German bonds, let's say from 2012, these were those project bonds related with the financing of the renovation of the motorways, and they were 27-year bonds, and they were secured. These were not just short-term bonds. The idea was similar because, you know, the mortgage bonds are like, let's say these are bonds with double security, because they're secured by the bank of the issuer, and also they're secured by the real estate. Compared to MBS market, during the crisis, they did not even move. I'm talking now about the instruments which have similar purpose, but they're a bit different in terms of security. So I completely share the opinion of the chairman here. I'm sure it requires cooperation with KNF, but not by loosening the restrictions. We should rather increase them, because if we don't strengthen the restrictions, that we will not strengthen the market of long-term secured bonds. Thank you. We prolonged this part devoted to investments a bit, but I see that you are also interested in 2 other topics that I wanted to discuss. So now one broad issue, and I will give you the chance to choose what you want to answer. So we were talking about savings, whether we have a lot of them or not. We generally tend to say that we don't have a lot of savings in our economy. Even the rate of savings is low. As the share of GDP, also financial assets as a share of GDP is one of the lowest in the EU. And on the other hand, we have money in the banking sector, so we have a lot of liquidity and the money is not used. There's a structure of savings. We have a lot of savings in cash. Do you see a way to decrease this over liquidity of the banking sector? Is it a reason to be concerned or not? Would anything be changed at all so that those non-profitable savings can be moved into more risky ones, but with more potential profit? And also those personal investment accounts that the government is about to regulate. Does it make sense? And the last thing that I want to ask you about is that I have the impression that we are used to think that the domestic savings should be spent on domestic investments. But maybe we should think that our capital markets should finance also foreign investments. If others are able to maybe have better ideas. But our future retirees can benefit from this. Mr. Mravitz, well, you provoked me a bit with this question. Well, drinking tea does not exclude drinking coffee, so we can do both. But when it comes to the mortgage bonds, remaining in the trend of safe investments for just an ordinary person, when we look at the structure of savings, over half of it is the deposits. If we look at the capital share of investment funds, it's 20-something%, and then we have various retirement programs which are also safe. So we can draw a conclusion that over 70% are those safe instruments, and people are looking for this security. You mentioned covered bonds, project bonds. We were talking about mortgage bonds as a safe instrument. I would mention rates here. But we could do it different than it was done in 2018, because at that time there was an idea of companies that were investing into the real estate lease. And there were certain requirements that certain percentage need to come from like household real estates. And I would not argue too much with these arguments, but if we look at the structure of rates in the USA, then when it comes to the whole population of rates, only around 10-15% are are in the residential sector. Individual it's around 5 percentage points, and the rest are like common residential buildings. So it's around 15% residential sector, and then the rest is other real estate, and non-residential is offices, commercial centers, industrial logistics. In a country like Poland, where logistic centers are being constructed, maybe we should give the possibility to everyone that when those logistic centers are constructed, it's not a foreign company with certain financing that has to do it. Maybe we can also construct such a center, and maybe we can implement such an instrument which will be functioning as a rate, and which will be like a company that invests into this real estate. But it does not have to be so complicated, as we hear now in the works on the scene. So that is companies investing in real estates, and that should be a listed company with 100 million capital. These are the requirements. But I'm trying to show the essence of this proposal. I would suggest that we create rates and we exclude the existing residential. So rates cannot touch the existing buildings. If they build them, then okay. But retail, industrial, logistics, data centers, telecommunication, It's all done to a large extent, but it will still be ongoing. So let's give ourselves the possibility to invest in something that will be created in Poland, constructed. And those numbers, 60% of export from Poland is done mainly by foreign companies. So if we look at service, then it's around 90% of foreign companies. So let's give ourselves the right to something that is constructed on our land and is safe and has been tested globally. But let's exclude the residential sector. The rates that you are talking about, this is not competition to project bonds that were suggested by Professor Pawłowicz. No, I think the palette is broader. We're not talking about competing. We talk about real estate, about financing, but it's a different story. Professor, sorry, let me start from some personal banking story. I should congratulate Mr. Papierak because I was starting the project of the mortgage bank for PKO, Polish bank, but in the previous century. So I'm glad that this project has been finalized and that it functions so well and is able to find individual investors for the securities. I like statistics very much, as you probably noticed, because we can draw interesting conclusions from the statistics. When I was preparing to this meeting, I looked at the statistics that is provided by the National Bank of Poland, is the structure of national assets with a high level of liquidity. And I looked at this structure from 2015, December, and then 2025, and from 2016, more or less. And I have some interesting conclusions. It turns out, I will tell you which items were growing. There is cash, deposits, securities, listed assets, and so on. You mentioned them, but the share of cash grew by 3%. The deposits in zlotys dropped by 7 percentage points. Who was the winner? The winner was the Minister of Finance, because his share grew by 6 percentage points. So that shows us that not so much has changed. We are trying to activate the investments and financial assets of the households. Our colleague from IMF clearly said that it's better to do it maybe at a low risk. But there's another statistic that is interesting, and it's not so well known. We also have the information about the investments of households abroad, their investments abroad. So on the scale of the whole value, around 2% of households invest abroad. What is the structure of investing of those investments? Currency deposits, only 10%. The security papers abroad, listed shares, and then investment funds. So let's compare two drastically different worlds. Of course, the answer could be very clear. It shows where the middle class and upper class in Poland is investing. But can we conclude anything else from this? First of all, it's about making people familiar with the risk. So we need to show people what they can afford in terms of risk. Secondly, it shows that the cost of access to other financial instruments, other than those simple banking instruments, those costs are quite high in Poland. When I look at the size of the investment funds, we have a lot of them, really. And if I am to rate what is the difference between the investment policy of one and another fund, I have a lot of doubts. But the question is, What would happen if we had much less of those funds, if the value of the portfolio of one fund was comparable to any foreign funds? Then the margins that the funds are taking would be much lower, and then the interest would definitely increase. I'm not saying that the regulators should cut the competition, but we have some experience, for example, in retirement funds and after the reform, and we were able to show that the system of setting the margin was very important for this system. Thank you very much. And now Mr. Papierak.
I'm quite confident that you never have enough savings. Just save, save, save as much as you can. And again, let me look back at my 30 years of experience. Years ago, everyone was saying that all it takes is one generation. You will change habits, people would get wealthier, people will save. Well, the life showed that 2 generations is not enough. In terms of mindset and culture, we are still trying to keep up with others. We are spending a lot, we consume a lot. 99% of people want to have more than they have, myself included. And there is nothing wrong about it. But I think that there is this thought in our mind that not yet. We cannot give up the consumption today for the sake of what's going to happen in 20 or 30 years from now. Perhaps the current generations of people who are in their 20s or 30s will be bolder and will invest in various financial instruments. They will go beyond the CDs and the bank deposits, because today it's not a good picture. We continue to complain that people hold a lot of money in current accounts. But I've already said that. I guess this is the matter of saving culture and the mindset that we have. What we can do is to educate, and get the message across. We cannot stop doing it. Each of us has either good or bad experience. Myself, I have 3 children. Each of them was offered a financial instrument, like the endowment sort of instrument. After 12 years, I decided to cash back 50% of each of these instruments. It's not the best experience, but we cannot give up on that. We have to keep on learning. We have to explore covered bonds or mortgage bonds. Perhaps our children or our grandchildren will be ready to embrace other financial securities. Okay, let me just say that there were several Nobel Prize winners who made it very clear that, actually the loss is more painful. You have more pain from the loss than the joy from the gain. And this is why Polish people would rather stick to the bank and would not venture out to the capital market. So education is badly needed. I'm in full agreement. But if you don't have any profit, any return, it hurts. Then if you get 2% from your bank, you are happy if you are Polish. It somehow keeps you happy. So the lack of financial education is definitely visible here. Polish people are scared of the capital market. But there is also a flip side. Even if they want to venture out to the capital market, there is not much to choose from. Mr. Ryzyko mentioned MiFID. Well, when they start to complete the questionnaire, at the end of the questionnaire, they find out that they are supposed to buy treasury bonds. That's why we have 170 billion zlotys parked in treasury bonds held by the Polish people, who either have current accounts, like 450 billion in term deposits and 170 in bonds, and some other tiny things. And there are two things in play here. Supply side, simply speaking, we don't have the depth of the market here in terms of like the offering that would be understandable and embraceable to the Polish people so that they are not scared away. And on the other hand, the financial education so that they dare to take up some risk. I think that there were two of them when that came up with the concept of behavioral economics, and they made it very clear that we are scared to take a loss. So our savings are not that negligible. We actually increased our saving rate. We are still below the EU threshold of 14%. This is the EU average. But we used to be at the level of 3 or 4% not long time ago. But the breakdown, when you look at the breakdown of savings, it's suboptimal. We just hold the money with the bank because this is safe. This is something that is easy to understand. And now the second thing, in my opinion, you need to think about the capital market, how to make it more attractive and how to make it more accessible, how to make it easier for people to get to the financial market. Because when people plow through the MiFID questionnaire, the final conclusion is buy treasury bonds. Well, yes, but on the other hand, it's so easy to buy stock today, to buy equities, even on the international markets. Yes, but it's young people who take it up. Yeah, but young people will come of age. Yes, but they don't hold the greatest savings in this country. Yes, that's right. But would OKI account help, in your opinion? Help with what? Help to make capital market more popular amongst Polish population. Perhaps to some extent, but it's not going to solve the problem. We need to have an adequate supply of financial instruments that would be aligned to the mindset of Polish people and the financial education that they have. This is what we need. I believe that OKI account will help. And again, I'm going to refer to my own experience, but I remember the rally on the banks when the tax was introduced, 19% taxation on capital gains. This is a lot. This is a heavy capital tax. So I think that if they can invest their money without taxation, they will be convinced to do it. And if this is possible to invest 100,000 zlotys, and Professor asked the question, what to invest it in? That's our responsibility to make sure that there is an offering. And again, I have to get back to the mortgage or covered bonds, because covered bonds are as safe as treasury securities. This is your dream instrument. If you want to have ETFs, I don't know if it's a good idea. But, everyone makes their own decisions. Everyone makes their own choice. I believe that this instrument and this product will help 100,000 zlotys. This is a hefty limit. If you can save 90% of your profit, I'm sure that a lot of people will be tempted to do so. Okay, so it's time to come up with the short summary. Each of you, please name one thing that will help encourage Polish people to invest in the capital market. If there are no ideas, then we have a question from Slido. It's a penalty question. You have to tell us how much you have in your long-term savings. Personal disclosure, but not in terms of the absolute amounts, but as a percentage. Look, you imply that this is our responsibility to encourage people to get into the capital market so that we are able to grow it. But I would approach it from a different angle. I agree with with Mirek Kwaśniewski, who says that we are overly regulated and the market is closed for the smaller players. We don't have such a large number of stock exchange success stories that would ignite your imagination, but people would hear the stories of how you made it investing in stock exchange. Obviously, we have the most complicated tax system in OECD. Now we have the whole system of employee pension schemes, individual retirement accounts. Now we will have European individual accounts, etc. At some point, there will be too many questionnaires to complete before you want to invest. So I would rather look at the European context, and I would think about the principle of real proportionality, so that we have attractive companies, and the success will speak for itself, and it will attract people. But before we succeed in it, or we don't, because perhaps we will be squeezed by the EU regulations. So another idea, a plan B, is rates. So as a safe option that would continue the journey through the real estate investment. But I would put the housing out of it. Okay, you said that you don't want to make it complicated, and then you speak about rates. Well, okay, I'm not going to explain the full concept here. The full concept is that you start with the blank piece of paper and you think how you want to actually make sense of this employee pension schemes, PPK, IGZE, individual retirement account on top of it, and how to top that with safe options for real estate investments, non-housing. Well, I agree that we need to escape the system, but we need to simplify the system, because it seems that someone thinks that they have the best idea, and they try to come up with their own idea without thinking about everything else that is out there. So what we shall do next? Well, we should not continue the existing complications, and we should educate. And it just takes time. You have to highlight good examples. You have to teach people. You have to encourage people, so that at the end of the MiFID questionnaire, the only thing that you can invest in is the treasury bond. I shared my secret about my investment with Professor, about my questionnaire. So, as I said, you have to educate, keep it simple, highlight success stories. At some point, it will get traction. Well, Polish people are clueless about covered bonds. They've never heard about it. And this is a super safe instrument. All you need to do is to sell it. You are half Polish. You come from the Kashuby region, so you're half Polish. So this is an excellent story, but an average person has no clue what the covered bond is. And then when they complete the MiFID questionnaire, they can buy the T-bond or covered bonds. Professor Ryzyko, education, that's number one thing that we need to do. And regretfully, I have to say that at the time, we had topic taught at the high school. It was called enterprise or entrepreneurship. And one of the influential politicians said, we don't need that. Everyone will work for the corporations. I think that it was a horrible comment to make in the public domain, because this financial knowledge that we are talking about right now should be taught at high school. Then we would have a generation that would have a different outlook. And this is the first thing. The second thing, I will be stubborn about it. We need to have plain vanilla products, plain, easy to understand. The success of the treasury bonds proves that people are open to the new instruments. During the past 10 years, the T-bond portfolio evolved tremendously, so we have to follow that way. And on top of it, it should be inexpensive. So, the cost element, when you switch from one instrument to another, commissions that are charged. And you asked about my personal investments. I invest in my grandchildren. Well, the return rate is a big question mark, but I'm doing my best. Professor Pawłowicz. I should say that, the ideas are always good. Also, the OKI account. It's a good idea because it should foster savings. Now, other things that go against these ideas are bad. For instance, why you can't use foreign exchange reserves to finance defense spending. If the risk of war is higher than the risk of exchange rate, then you should really scratch your head and think how to approach that, how to do it. So we should really look at it and put it in the realistic framework. I agree with Mr. Ryzyko. The OKI is a good idea because this is an idea. How to channel the savings. But the question is where the savings should go. Should they be invested in ETF? If you want to make a bet, go to the bookie and place your bet, or go to a casino. But that's an excellent product for a casino. And now, let me get back to the capital market. I believe that the greatest value of the capital market that we can build is credibility. Even the best instrument will never be successful on the capital market that has zero credibility. I'm looking at Wiesław Rozłucki because at the time we had this proposal that we should follow in the footstep of Malaysia. Malaysian stock exchange was competing against Singapore stock exchange. And all the fundamental analysis were made for all the listed companies. It was very transparent. Corporate bonds floor was very transparent. And there was an idea to set up a rating agency in Poland that would be less expensive than Standards and Poor's or Moody's. But that idea faded away. And now, if you want to add credibility to the capital market, especially the bond market after this scandal that we had with GetBack, because GetBack really destroyed the whole credibility. So this is one thing. Another thing is project bonds, but properly secured, backed by the treasury assets. That's my proposal. Thank you. So that once you go until the end of your MiFID questionnaire, you will choose between cover bonds and treasury bonds and project bonds. But ETF, my best ETF investment was ETF on Standard & Poor's 500, S&P 500. Well, thank you for this discussion. I think that we were going sideways on occasions from the main topic, but perhaps it was for the benefit of the capital market. Right now, we are taking 20-minute break, and after that, we follow with another discussion.
Okay, we will be starting the second part, and we have Professor Monika Marcinkowska from Łódź University, the President of the Management Board of ING Bank Śląski, Mariusz Jaszczyk, Vice President of the PFR Fund for Finances and Development, Mr. Rafał Kozłowski, Chief Financial Officer in R-Power, Bartosz Pawłowski, President of the Board of MTFI, and Mr. Janusz Rywka, Director of the Financial Market Development Department of the Polish Financial Supervision Authority. Maybe we already said things that should be said now in this panel. No, but we will address those topics with pleasure. Thank you very much. Thank you for inviting us. And also, I'm glad that we have some observers, some audience. You know how it is with professors; they like to talk around the topic. But I will get back to the point in a minute. And let me also confess something. Since I moved outside of the city, I love to observe the nature. I love birds. I love ravens. They are very intelligent. And recently I came across some research from Oxford researchers. They tried to replicate certain experiments, psychological experiment. Maybe you remember the marshmallow test, which was checking if children can postpone consumption if they can they can get 2 marshmallows instead of 1. And it turned out that they did this experiment with birds also, and with jays, and it turns out that all the birds were able to wait for the better snack instead of taking an immediate reward. Some of them could wait even 5 minutes, which is quite a good result. So researchers drew a conclusion that it proves self-control, the ability to resist temptation, the ability to be patient and to wait for delayed gratification. And this is the basis of good decision-making and planning the future. I'm not so far away from the topic, actually, because that's what we will start from. So my first question would be, how can we convince Poles to be like those birds? PPK, we currently have a period where we can change the regulations. Let me just add. A few years ago, the financial barometer of ING was showing that over half of Polish citizens, when they were asked who should take care of our retirement so that we can have we live in dignity in the future, they said that it's the state. On the other hand, when the state is organizing certain retirement systems, it turns out that it's very difficult to convince Poles to participate in them. For example, only 57% of entitled employees put their financial resources into PPK fund, and if they do, it turns out that they found out that they can actually withdraw money from this program. And so for the third quarter of last year was a record when over 1 billion zlotys was withdrawn from the fund. So people see the possibility of maybe gain, but a very short-term profits, which is, not so attractive when we think of the purpose of the program. So my question is to Mr. Jaszczyk. How can we encourage Poles to be willing to use this program, or how can we change this program to eliminate those unplanned, the behaviors that were not planned? Yes, let me tell you one word that will probably make you smile. Education. But before I continue, let me just argue with the thesis that you presented in your question. Because what is PPK? It was clearly communicated that it was a saving long-term program. When the program was being created, they were not using the word retirement or retirement program. Now, after years of the program functioning, there's a discussion whether the program, even though it has a long-term character and its purpose is to secure our elderly age, should it rather move towards a retirement program rather than saving program? And then payouts. Because those amounts grow, but they grow because the assets grow. So the facts are that on the 1st of January 2025, the assets in PPK amounted to around 30 billion zlotys. On the end of December last year, it was 45 billion. So there was a 45% growth during 12 months. So also automatically the withdrawals were higher because there were more assets. Today there are around 48 billion assets. In 2025 they were really at a very high level because the situation in the capital market was really great. So it was growing naturally because people were making payments, and it was the growth of 15 billion zlotys in total. And as a result, the assets grew by 49%. And as I was observing it, we as Polish Development Fund, we are responsible for verifying the PPK, but also we provide information about the program. And the percentage of the withdrawals is at the level around 8% of the members of the program withdrew their resources at least once. And if you look at the act of PPK, which says that the resources on the accounts are private property of the people who are saving money with this program, so the fact that the person who is saving has the possibility to withdraw the money, and this is the proof that this is their private ownership, and the people who withdrew the money, at least once, they wanted probably to test if this is really their money, and they succeeded to withdraw the money. And how do we encourage people? Well, I see some hope when I look at the data from January, because if we look on average how many members were joining PPK, on average monthly there was 36.7 thousand people joining PPK. In January itself, over 61,000 members joined PPK. I don't know if it's because of the New Year's resolutions, or maybe people just noticed and understood that the program really gives real benefits. Yes, but at the same time, in January, around 70,000 people resigned from the program. Yes, the advantage of the program is to emphasize the private character of the savings, and withdrawing money from PPK can be done in two ways. We can either withdraw or we can make a return. We can withdraw because, for example, our health state has worsened, so we can withdraw up to 25% of the assets without any consequences, or we can, let's say, borrow money from ourselves when we need them for the residential purposes, and then we need to return the money at a certain with a certain deadline. So these are the so-called withdrawals without consequences, but making a return, let's say, because someone decided that they want some supplement to their salary, is related with the fact that part of those resources go to the sub-account of the social funds, and is related also with certain tax consequences. Okay, so there is a possibility to withdraw, but it addresses a certain problem that is often specified in various surveys. When we ask why Poles are afraid to save money with such programs. I remember that people were mainly concerned whether the money was theirs and whether the state would not take this money from them. So this is, so when they can withdraw money, it allows them to test if this is really their money. Yes, the act was written in 2016. It entered into force in 2018. We started to join the program in 2019. So people still remembered about the open retirement funds, and they were afraid that someone would come and take part of their savings. But now, from what I observe, and I'm really trying to be up to date, the case of open retirement funds is not about, does not convince young people, because young people don't remember about this situation, about this case. And what about Director Rywka? Do you have any suggestions related with regulations here? I would like to speak about PPK in a broader sense, because in the previous debates we said that we have a lot of retirement programs, and when we think of investments, there is the rule of diversification, and it means that we increase the elements in which we invest in order to decrease the risk. But there is certain limit when it becomes less productive due to costs. But if we confront it with the amount of various retirement systems or long-term saving systems that we have at our disposal, I would risk a hypothesis that increasing the amount of various retirement systems will not increase the potential or will not convince people to save more because of the large amount of the systems. Going back to PPK, it still has a lot of potential, and in my opinion, this program is really much better than other long-term saving programs. First of all, its potential is mainly related with the fact that there are certain elements that can increase the participation in the system. For example, it says that micro companies, micro enterprises can be excluded from the system. And maybe it's the right moment to actually include those micro enterprises on a mandatory basis. Because we were talking about the supply of capital. Before, we said that the structure of Polish economy is that we have around 2 million employees, 2 million micro companies and several million of employees. So it gives a really big potential. Then the modifications related with the PPK program, I think that they should also focus on making certain elements more obligatory. For example, covering micro companies with the program. Another element that we should think of, which should be obligatory, is that each new employee should be included in the program. So the first declaration could be, let's say, submitted only 1 year after joining the program. So this is my digression. So I think that there's still a lot of potential in the program. We are currently making a review of this act which regulates PPK. There are still other elements that we should consider and maybe change them. From the point of view of investment, PPK, there is something that is called the so-called home bias, that is fixed rules of investing that are preferred on the Polish market. I understand the reasons why it was implemented, but from the point of view of the members, this is not the best solution because it limits the scope of investments when it comes to the members. So, in my opinion, PPK should have broader possibilities to invest in foreign investments on foreign markets. We should not only focus on the Polish market. When it comes to investment policy, in previous panels we were discussing about the mortgage bonds. So I think that in the rules of investment policy of PPK and referring to the rules related with investing in the debts, then there should be also the mortgage bonds included there. Theoretically, there is a possibility to invest in such instruments, but also entering the mortgage bonds officially into the catalog would be really a good idea. And going back to the aspects that I mentioned, so obligatory elements. In the previous panel, we were talking about financial education a lot. Yes, I agree here. And I would even say that if we add a new member to PPK, and this is a new employee to PPK, and this is obligatory, then when we provide the health and safety training to the employees, we should extend it by the rules of the functioning of PPK or saving in general. And from the point of view of the risks, which we will also be discussing probably in a minute. Yes, let me just add, we are working on it, and I think it should be ready in the middle of the year. So training for employers, that will help them, make it easier for them to provide them information about various retirement programs. So we are going to prepare such a training that will explain the employees how it works. Yes, and it will show them the return on investment also, right? Which is tempting. I would be cautious here. Well, I would be cautious. It might be difficult to repeat the success, but yes, PPK is much better than other saving systems, as we said. And when it comes to the way we make payments, I mean here there's mechanisms that, for example, you know, to put it simply, if the member pays 100 zlotys, the employer adds 75. So from the early start, I have the return of 75% right at the beginning, and then the state. Yes, so there is some like welcome package, let's say, and then some annual bonus. Yes, so I said 57, but it's still a lot when we look how the program was developing. It was growing quite slowly, so we would say only 57%. We would like more, but we still see that this is quite of an improvement. So the program is well thought. But there are a lot of these programs, as we said, PPE, PPK, and so on and so forth. So I would ask Mr. Pawłowski, is there anything else? Because in the last session, we said that we are still missing something. More products. I'm wondering when the number of retirement programs will exceed the number of voivodeships in Poland. So I think that we really feel that we are a bit saturated. So when the diversification is too large, then, you know, it's not, it decreases the profitability in the end. Yes, and when we were also talking about those possible new products like cover bonds, mortgage bonds, there are a lot of options. we don't live in such a reality that Polish people do not have possibilities to invest. There are brokerage houses, there are investment funds. The offer is really huge. So it's not about creating new instruments, as Professor Ryzyko said, that we should actually have less of those options. So I agree with this. And another thing, we have representatives of the academia here. I don't think that the education is a problem. I'm sorry, but in the surveys, Poles who are 15-year-old do better than Americans, and constantly. Maybe maths is not strictly about finances, but it's close. So, and it's the Americans who invest in capital markets. So I checked among people at the age of 30, 35, every second person has higher education. So how can we say that Polish society is not educated when during the last several years we made a huge progress because the share of people with higher education really increased, and we are really happy. And despite that, the capital market is not so attractive. We were talking about the capitalization of the stock market, about 1/10 of GDP. So PPK, which I'm really a big fan of, and I can speak objectively because I'm not trying to sell anything, I'm really objective. This is really a great program. I remember in the bank, we were discussing with the directors and we were asking who opted out from the program. Well, most of them did, but during the last years, maybe did people forget about the problem with the open retirement fund? Well, no, I don't think so. And my suggestion and my explanation is as follows: the return rates.
So when people joined employee retirement schemes, and they stayed on, and they heard that the neighbor made that much on that, and that it actually is growing, suddenly they are all in, not because they have more trust in the government, it's because the return rate makes sense. Look at the US. Most people, when they travel, they would be rather on the coast. But if you look at Iowa and Des Moines, people there do not follow financial markets every day. They don't wake up and try to figure out Black-Scholes formula and invest better. But principal asset manager, it's the management. This is the asset manager from Iowa. And they have assets under management, $593 billion. Not because people of Iowa are better educated. It's in addition to the products, you have to make sure that people have good user experience with their investing. This is how Americans build their capital market. And finally, let me ask one question. Think about it. Today is Thursday. Let's say that since next Monday, week 20 of the Polish Stock Exchange would be going down by 10% week by week. You think that anyone would actually invite an economist to the leading public affairs program on TV, or would it make the news? Well, it would make the news in the financial media, but not in the general media. In the US, when the market is down by 3%, everyone is talking about it, and politicians address that. So I think that the key is not to look at the number of products that are available. It's not all about the education, which is important, but moderately important. But I think that if not a good performance of the Warsaw Stock Exchange, PKO would never have the success with placing their mortgage bonds. Okay, fingers crossed for the Warsaw Stock Exchange. Well, let's look at the flip side. We've heard a lot of statistics, how much money sits in the banks or in the open retirement fund or retirement schemes, etc. 51%, it's term deposits, basically cash. But if you put it all together, and if you look at the long-term investments, you need to ponder how to actually use that to support our investment needs. For instance, the infrastructure of the country. According to the BGK report, 380 billion zlotys. This is the estimate by Deloitte. This is the investment gap in the infrastructure. According to the World Bank report, where they were actually focusing on the climate and the economy growth, the estimated investment need of the Polish economies of over the course of 5 years was $450 billion. And this is a discounted amount. And in the power sector alone, it was over $100 billion. Obviously, the question is whether companies have such a capacity to invest and whether they want to do it. Other survey by BGK shows that only 5% of companies in Poland have some growth potential. And they didn't invest because of the access to capital, whether this is own funds or borrowing. And then there was another question about the barriers to investments, and the access to capital was pointed out as one of the reasons. And the same is true when we look at the central bank surveys that look at the lending market. But now, let me turn to Mr. Rafał Kozłowski. How to mobilize the money so that we can support the investments that are badly needed. I've been with the power sector for 18 months, but prior to that, I've been in the banking sector, so I have a dual perspective. Now, there are quite a lot of infrastructure investment projects. Because sometimes you can hear from the banks that there are no projects out there. Yes, there are many projects by private companies, private Polish owners who are supported, mind you, EBRD and the BGK when it comes to equity. So it tells you something. So we have development banks, European and Polish, that supplied capital. BGK is our development bank, and EBRD. These are not commercial banks. These are, let's say, development banks or like mission-driven banks, and altogether they hold 30% of equity in the company that I work for. At the same time, we are quite heavily leveraged with the local banks. And there was no problem to get to borrow from the local banks. They have deep pockets because they have very high capital surplus, so they can actually issue money, and that means that they have both the loan and the deposit at the same time. So in Poland, you don't have really limitations to borrowing or lending. And the scale that you mentioned, Professor, doesn't make any impression on me. I think that we can easily handle that in Poland. Now, what the bank would like to see? They would like to see no risk projects. So they want to have a fully predictable cash flow. And let's say that the variance could be 10% max. Everything else should be more or less constant over the horizon of 15 or 20 years. Is it plausible? Is it doable? Yes, it is. When you have well-developed projects, we can actually come up with the cash flows that would be satisfactory to the banks. Banks have very clear expectations. They are communicating that openly, and we are able to deliver that. And the banks say, okay, if you're not able to deliver that, someone has to take up the risk. And in Poland, this is a PFR, in other words, KUKA, so insurance branch, so to speak. So they use the state treasury rating, reputation of the state treasury, of assets of the state treasury, to back the investor, such as my company, so that the bank is happy and they know that someone will repay their loan. So KUKA, this insurance agency, loan insurance agency is an excellent solution here for the debt predicament. So I spoke about the leverage, I spoke about development contribution from the development banks, and here we have no limitations. Everything is clear. The problem starts at the early phase of the project. This is where you cannot get borrowing. Let's say that you are just developing a project. You are applying for the connection fees. This is like 3 million zlotys per project, and soon it's going to be twice that much. So you have to invest like 20 million upfront. And financing of that early phase where you are not building anything, you don't have a customer to buy your electricity, so you are not able to demonstrate cash flow to the bank, and you have to pay upfront a lot of money, well, that's really not working out in Poland. So in this case, we are using French funds. Well, in France, not only in France, they have it in the UK and in other countries, but they do have infrastructure funds that have a lot of know-how about infrastructure projects development, and they are able to provide funding for this early phase of the projects. And where they take money from? They take from the long-term saving funds. So retirement funds or mutual funds or whatever, they are long-term, and they don't need to be knowledgeable about infrastructure. They just invest in the infrastructure fund, and the infrastructure fund is raising money to invest in the early phase of such project as ours. But the retirement funds, etc., they don't need to have analysts or experts who will specialize in road building or infrastructure. They work with someone who knows about it. And in Poland, we don't have the infrastructure fund, the fund that would invest in infrastructure projects. I mentioned BGK Bank that actually operated through the 3C fund that they have, and they invested in our company. They bought equity. And then I was speaking about the debt segment, and the debt segment is not covered by the infrastructure fund, as we don't have it in Poland. So we have enough money. Banks can create money, and Professor, you said that assets have millions or billions of zlotys in assets. We have KUKA, the insurance agency that is insuring loans, and they are really efficient. And then there are companies like us who are actually developing projects and have 5% market share in green energy in Poland. Two private guys. I think that infrastructure funds is a very good idea, because banks may be interested in investing, but let's keep in mind that they invest their customers' money. So they don't take too much, they can't take too much exposure to high risk. So I would rather look at private equity or infrastructure funds, but this is 0.15 GDP. This is private equity investments in 2024. This is 3 times lower than the average for Europe. So that's another market segment that we have to develop. Would you comment on that? I would follow up on Mr. Kozłowski's story. He's well familiar with the banking reality, and now I can tell that he's well versed with the power sector. But from the point of view of the long-term funds, because I agree that banks should not be the clients of the infrastructure funds, because they have different horizon for placing their money. As Professor, you said, the retirement funds. Today we have 310 billion zlotys in open retirement funds, and 80% of that is at the Warsaw Stock Exchange. We have employee retirement schemes, PPE, and the most recent data is from December 24, and that showed 29 billion. So today it's probably 45 billion, and we have PPK 48 billion, IKSE, so individual retirement accounts, it's probably 40 billion zlotys. So my point is that we have asset classes that could be shifted towards investing in infrastructure fund. a percentage of their holdings. But today it's at zero because of the legal regulations. The law requires that the funds keep sufficient liquidity. They have to come up with the daily valuation. The projects that you have just described may not have a frequent valuation. It's just not plausible because this is a long-term project. And I understand that there is some work underway to actually open the gate for such funds so that they can invest in the private market. And altogether, it would be tens of millions of zlotys that could be redirected there. And one more thought that I would like to share. You might have heard that as a PFR group, together with BGK, we launched the Innovate Poland program. So far, it's been 4 billion zlotys, and this is our offering for the private market. We want to engage private funds, investment funds, so that they go with us and we co-invest together in innovative projects. Today it's PRF and BGK and PZU and the European Investment Fund. I do hope that this program will eventually help get traction with the shared investments between public and private capital. Yes, but I understand that there is a technical problem, that the daily valuation is required under the law. But when you look at OFA, retirement companies, retirement funds and others, they by definition should have long-term savings. So, you can reframe it. You can say that instead of that, you can value the project that is funded with this debt. So OFA, it's altogether when we combine the two, it's a lot of money, like 40, 80. So as we said, we have quite a lot of money available. We just know how to mobilize it. And as we heard before, this is doable, this is plausible, and you don't really need to use the state treasury assets as a direct collateral. You may basically use the long-term savings or KUKE agency. So PFR group is like a vehicle that should help mobilize funds and help trigger investments. But the true gap that we have in Poland is an infrastructure fund that is non-existent. Okay, so we have some postulates or suggestions for the regulatory authorities. But let me revisit the question of risk. When you ask Polish people why you hold your money with the bank and where you get 2% at most per annum, well, we've heard the reasons. Most people would say because we are afraid to put it someplace else. It is true. Our survey showed that people in Poland have high risk aversion. Every second potential investor can accept a tiny loss. Every sixth investor does not accept any losses whatsoever. So 2/3 of Polish people would never accept a loss. So non-investors, so the question was why you're not investing at all. So people who avoid losses, who have high aversion, 9 out of 10 altogether. So that's really skewed. And another survey by Warsaw Banking Institute showed the same facts about the risk. These studies are interesting because they are repeated in a cycle. So you can track it from year to year. How many people said, I'm afraid of the risk, I am afraid of the losses. This is top of mind answer that we get in such studies. Most often, people are afraid of losses. They are afraid of the risk. They say they don't have time to follow the market and the news. some people, okay, 1% of people have no concerns about investing. 1%. Okay, so another national survey of investors from last year, the greatest weakness of the Polish capital market. And also risks. Politicians and politics and their impact on the local market. Poor liquidity, susceptibility to volatility in the international markets, poor corporate governance, the minority rights not respected, but also frauds. So how to overcome these problems? Because they really fuel risk aversion. I think that such surveys and studies have one flaw, because when you ask someone, what are you afraid about investments? Well, the obvious answer is a loss. If you ask the same question to American people, they will tell you the same. What I'm afraid that I may lose my money. But the question is whether this concern or whether this fear generates avoidance behavior. And my experience from working with customers is such that the risk aversion is much lower in reality than declared. In other words, they may swallow up some more risky investments, but they may not. Perhaps they are not used to it, or they might have had bad experience in the past. So I believe that this problem, I'm afraid that I will lose my money. Well, this is something that you cannot really address, because if you want to actually have a gain, you have to accept potential loss that may come as a flip side. But I would look at other aspects because they are more interesting. And perhaps I would look at the breadth of investment offerings, the options that Polish people have. So when we don't have much time to invest in exploring these opportunities, and when you ask the question to the authorities, what should you invest in, you will never get a meaningful answer. Then the average person is getting discouraged. So they open a deposit with the bank, or they buy an apartment or some other piece of real estate, or they buy treasury bonds. But I'm not sure if this is really about encouraging people to invest in the treasury bonds. So my point is that we should really look at it from the customer point of view, what they want to get out of it. So, when you look at the people attending the conferences, many of them have iPhones. If you get to the Apple website, it's not that you have 50 models of iPhone to buy. You just have to use the memory choose the memory size and the color. Now, Tesla wins against German cars because if you want to configure German car, it takes you 3 weeks to configure it. And then it turns out that with these windscrapers, you cannot have a 4x4. So we want to really focus on making it simple for the customer, because customers have no time to ponder about it. And like a private individual in any other situation, you go to see your medical provider, and the doctor will not tell you, look, there are 14 cough products to choose from, make your choice. The doctor would prescribe you something. When I have a legal problem, even if I have the legal knowledge, I will consult with the lawyer. We learned when we were kids that you have to brush your teeth twice a day. And if in trouble, go and see your dentist. So you don't need to study dental sciences. So, as Rafał said, perhaps infrastructure funds, etc. But that, I think that was your point. That should be open to professional investors. So, we can speak about the mortgage bonds or covered bonds, excellent products, very important. But at the end of the day, you have the customer who will be clueless when you speak about complicated structures. And the customer wants to have the rate of return and a simple product that can be understood. They will always be scared to some extent. But, sometimes you have to be scared.
Okay, let me just add, on a long term, those losses, usually you can make up for those losses. Yes, the government, this one or the previous one, we created the great BBK program. It's really fantastic. It's really too good. But the problem is that, as was said before, we should maybe limit it a bit so that people cannot withdraw money, but I do not recommend it. But this program is too good. I spent a lot of time working abroad. They also have retirement programs, but I have not seen any program which would be so good for the customer. And indeed, the customers who automatically fall into this program, they are happy because the participation is growing. So I think that if we translate this safety training that you mentioned, they do not really fill in the MiFID survey. We just see when the person was born. And by their PESEL number, we decided this is the only fund for them. Well, I don't want it maybe to be that way in private investment, that there is only one fund to rule everyone, like in Tolkien's books. But, we have a success story with PPK, so let's try to see how we can use it in individual investing, to which we want to encourage people. And the discussion about the mortgage bonds and so on, let's just discuss it among people who should invest in it, so among infrastructural investors. Okay, the risk of loss is one thing. Purely financial loss, because let's say something changes on the market, but another aspect of risk is the non-financial risk. Cyber threats, a lot of frauds concentrated on investments mainly, where by definition it's about stealing from the customer. The Financial Supervision Authority provides a lot of education, like prevention also, but I think that the number of attempts of fraud is growing, and it creates negative attitudes among those who wanted to maybe try, but they lost everything. Do you have a remedy for this? It's a very important problem, and I will address it in a minute. But first, I would like to share another thought regarding, let's say, this classical financial risk. Because why are we talking about the risk in the context of investments? The example of the aversion or willingness to risk is if there can be a level of investments with high volatility, like, for example, share funds, compared to the total of investment funds. And here I have interesting data, because when we look at the Polish market, during the last 5 years, the share of equity funds compared to the value of equity funds compared to all the investment funds was around 12 to 21%. But if we collect the same data on the European market, then in the same period, the share of equity funds compared to all the investment funds during those 5 years was around 30 to 35%. Why is that so? Because the level of aversion to risk among society should be more or less the same. So I think there are some elements that have impact on the perception of the risk, or maybe awareness. Of course, when it comes to Western Europe, the saving culture exists for longer. In the USA, probably the share would be even higher. But there are a lot of factors that create this risk, and risk perception. So the question, why don't you invest? If the person who is asking sees other possibilities, they get lost as well. So this can distort the whole effect. So it's about the share of risky investments compared to all kinds of investments. That represents the picture of the willingness to take risks. And when it comes to risk in general, we said that there are new types of risk, not strictly financial, but let's say technological risks. Currently, technological progress went so far that both financial institutions and all other enterprises use technology to a very large extent, not only as a supporting tool, but technology is the basis of business models currently. So both financial sector and the whole economy depend more and more on the use of modern technologies. And here the risk appears. The technology itself can sometimes fail. And with such a large scale of use of those technologies, various mistakes can result in serious loss or problems in functioning. On the other hand, because of the technology, there are also criminal groups which abuse this technology. So there is this technological risk, which on the other hand says that technology can be used to distort the functioning of various systems, not only financial. So we need to be aware of this. On top of that, there is always the geopolitical risk. And here, there might be the combination of the vulnerability of the systems which use advanced technologies and geopolitical risks. So we need to remember about this, and we need to build this digital resilience. But on the other hand, data shows that advanced technologies used by cyber crime, they succeed when they are correlated with socio-technical activities. That means that using technology is based on the old behavioral law of human behaviors related with greed and risk. And we see that the most, let's say, successful attempts of fraud and other financial crime are committed based on socio-technical behaviors. So we have to remember about it. And as I said about the health and safety training, I think it has even a deeper meaning here, because the best defense here in this case is to be aware that technology can be used together with social social techniques in order to steal money. So here I would see the role of education again. Thank you. And now, Mr. Kozłowski. When it comes to companies, we can see also quite a big aversion to risk. And it's the last year's research of Polish Economic Institute that showed that there is quite a similar share of entities who show high risk related with investing as a barrier. Of course, they also mentioned higher costs, uncertainty of the economic situation, unclear and stable tax regulations. So how do you perceive it? How can we motivate people to invest? When it comes to the willingness of companies to invest, on the one hand, indeed, when the law is unstable and unpredictable, it's difficult to invest on a long term, and this is crucial. So looking 15 years ahead requires certain stability of the environment. On the other hand, if we have a customer for 15 years for my goods, and that's how it works in infrastructure. For example, I can sign a contract for 15 years for the sales of energy, then the risk is also limited on our side, on the side of the investor. And on the other hand, when I have a quite quick path of obtaining the financing without too many obstacles on the way, then I will enter this project. Launching a project, like almost ready commercialized project, in our domestic conditions, it's 2 to 3 months to find money in the form of a loan usually, and to start investment. What takes most time is the first preliminary stage, and then getting the financing for the early stages of the project. That takes the most time, and then when you start to implement the project, it goes much faster. Let's say we decide that we have a customer for the product, for our service, and when we have the financing, then the decisions are quite quick, and the implementation of the investment is actually quite quick. But the access to financing should be broader and should be communicated more. You talk about retail clients, but when it comes to business people, it's about access to information. For example, KUKE. It's not common knowledge what KUKE does among enterprises, and they really do a good job. Okay, so let me continue on this topic of education. You said that it's not so bad, that Poles really are good at maths. A lot of people with higher education, we have a lot of people with higher education, and when it comes to financial knowledge, I think it's not that good. All the surveys that are conducted, and my department also conducts such surveys, and they show that even self-assessment of the self-evaluation of the financial knowledge of Poles is quite low, and still it's, I think, it's really overrated when it comes to the real knowledge, let's say, from standard OECD forms. I mentioned the general national investors survey, and the weakness of capital market is the low level of financial education. It's ranked second in the survey. And the survey about financial knowledge of Poles, I already said that it's mainly about aversion to risk. But earlier, for a very long time, the answer, I don't have enough knowledge about investing, was ranked first. Some people don't have time for analysis also. But this was quite a general question. Of course, we can still consider whether the knowledge is sufficient or not. But I was really scared about, I was surprised by the question about particular instruments. Like, do you know what are bonds, what are securities, shares? I'm not afraid that people don't know what mortgage bonds are, for example, or rates. But I am concerned that 65% of people, when they speak about shares, they say, well, I've heard about them, but I don't know what they are. 58% says the same about bonds. 13% say directly, I don't know what bonds are. And these are the most basic instruments. So how can we cope with this? Well, I will defend my opinion. A lot of people are afraid to fly, to take planes, but I'm sure that none of us knows really how the engine of a plane works. Nevertheless, we know that we have Polish airlines, lots that have been operating for years, that they use 2 or 3 planes of manufacturers who are very strongly regulated. Then there is the whole aviation controls over it. And even though we are afraid to fly, statistically, and we don't have the knowledge of how it works, when we want to go on vacation, we usually get on the plane because we believe that there is something or someone who makes sure that the flight will be safe. And if from time to time some incident happens, then it will be under such investigation that they will make sure nothing like this ever happens again. So that's rather how I perceive the world of investments from the point of view of individual investor who, as we said, is not really present on the market, or at least not the way we would like to. Again, the same people who don't know what bonds and shares are, they invest in those instruments through PPK, for example. And I would be glad, but they don't know it. Yes, I'm trying to say that, in my opinion, we don't need that knowledge, really. We should present the knowledge, just to teach people to have a habit of doing this, because to tell them that they will retire one day, they will need this money. Sometimes people think that several hundreds of zlotys is a lot of money. It is a lot of money, but if I start my retirement with the life expectancy of 10, 20, 30 years, even we say, we tend to sing Stolet, which is 100 years, because we want to live long, and when we retire, each of us needs to, be a millionaire to maintain our life standards. So that's what I would explain, rather than, bonds and shares and rates. When the professor says that we don't need to educate our society, well, when you say that we don't need to educate our society, then the professor might feel offended because, No, I'm sorry. There is another topic that we didn't mention today. Certain survey describes how Poles save, they don't invest, but one point was really shocking for me. One of the questions was about how much money you need to have in order to be able to invest. And the answer shocked me. In the context of institutions and investment companies, when this instrument is available really from a small amount. And there was some psychological barrier, people saying that it doesn't make sense to invest less than 25,000. Ouch, yeah, that's a, horrendous amount. There was this TV, TV business, and there was this TV show entitled A Million in a Wallet, and people, like economists, were invited to talk about it, and this was an educational program, but I think that it was not really good because it made people believe that in order to invest you need to be a millionaire, and it's the other way around. If you want to become a millionaire, you need to invest. And 20, 30 years ago, the threshold to enter the capital market were different. But at the moment, it's really enough to have like 50, 100 zlotys in brokerage houses. You can really invest with small amounts. So this barrier is the perceived barrier. So I'm not saying that we should not educate, but the education about what bonds and shares are, I would leave it for the second level. First, I would educate people about why they should do it, how they can do it in a responsible way, with a responsible partner, so that people know that there is someone who makes sure that I don't make some mistake, because otherwise we are pushing those people in towards the influencers who just speak, quickly, today is the moment to buy the Bitcoin because, just, catch the train before it leaves. And we hear this thing and this speaks to people. So if you thought that I'm against education, no, I'm not. But I think that we should first educate people about why they need it and how to approach it. Okay, let me just finish the sentence. Why do I need it? But also that, just putting small amounts aside, let's say 100 zlotys, after several years of investing by a professional company, you will collect some money. Okay, but I think that this is an interesting discussion also in this context, because when it comes to active role of the Polish household or each of us, I think that we have educational barriers, how much money we have. As you said, some people think that it's minimum 25,000, but we have a successful program that signs up the members automatically. So, maybe the solution for Polish society is to make it automatic, let's not believe in the active, proactive role of the citizens, let's just make it obligatory. Also, apart from PPK, no, but this is just an example of a program similar to PPK or that you can create. It's obligatory and the money is accumulated there. And then we can use this money for financing the long-term investments that we are discussing in the panel, whether in capital or through other investments. Maybe not directly, because not everyone will be able to do it, but maybe through some other instrument for long-term investments. And KUKE insurance company as a warranty of the success, and that's how it rolls. And the education will be important, please. We agree with that, but it turns out that maybe it's easier to do it by making it obligatory.
I really like the example of the aircraft. I'm afraid of flying, but I fly because I want to get somewhere. The same about investment, I'm afraid, but I need to. So, somehow you're required to do it. And I said that we should really have all the newly employed individuals in as a mandatory measure. I believe that we should reach the moment when everyone has awareness that they have to save, the same way they have to pay their bills. And if they want to drive on the public roads, they need to have motor liability insurance. So if you start your professional life, you get into the labor market, you have to buy an insurance against your retirement. So in my opinion, there should be some obligatory or mandatory component. And perhaps then education will follow. Perhaps it will not follow by itself, but I will not really make education a fetish here. Okay, one thing. If you have never invested before and you buy, I don't know, Apple or KGHM, you know how much curiosity it triggers? Suddenly you become an investor and you check how your company is doing. I noticed many times that people who cross the Rubicon and they start investing in Poland or globally, suddenly they developed interest in that. So to me, like, investment should be pictured as the pathway to a better future without getting into the details of sausage making, just like motor liability insurance. I remember that I had a course in actuarial sciences at my studies, but if they wanted me to calculate that, I don't know if I would be able to do it. Look, I think that there is legislation that would help present your retirement investments in the M-Obywatel app, so in the public app for all the citizens with their personal details. So if we added all these retirement programs to that, it would be possibly triggering more interest in people. And I agree that Polish people are very well educated in terms of maths, etc. But just try to think back. Remember your high school. You were able to actually calculate, the field of whatever surface. But now, if you have to calculate how many tiles you have to buy to finish your, bathroom, that's a different story. So this is just how you really formulate these things. If we had problems at the math class, how much you have to save per month to buy your first car when you are 18? We are really good when it comes to theoretical knowledge and formulas, but I remember how my math classes, we don't really know how to translate theoretical abstract mathematical programs into the real life problems. Yes, it's absolutely true. Even the results of tests taken by the elementary school graduates show that they have a challenge with translating math or other sciences into real life. So let's have health and financial safety program. And I don't want to replace this previous topic of enterprise that was taught at high school. High school is too late. You should start teaching about money in preschool or in the kindergarten, so the kids can actually understand what money is and what saving means. And you explain that money is not growing on the trees and does not come out of the wall, but is ATM. Okay, time is flying fast. Since this seminar is about risk and regulation, I would like to ask you, just for the sake of the wrap-up, to identify one piece of regulation that you would like to revise or amend or introduce to stimulate long-term investments through the capital markets. You can refer to the things that you have already mentioned, or you may introduce new ideas. Can we start with you? Of course. Currently, we are at the moment where at the European level, we have Savings and Investment Union initiative. And one of the aspects of these initiatives is to simplify regulations. And this initiative has not been conceived out of nowhere. It was noted that the volume of regulation is undermining the competitiveness of the European economy. I believe that there is an important element that deserves our attention here, namely MiFID. Perhaps it should be somehow modified. What I have in mind is an onboarding process, because this is the moment when the customer is crashing against the wall, namely a vast survey. I'm not saying that this is bad, because you need that to evaluate the investment profile of the customer and to offer adequate financial instruments aligned with their profile, but you cannot take it overboard. But at the end of the day, the customer would opt only for the treasury bonds. So our thinking is about things that can be done to encourage people to invest in the capital markets. So perhaps if we modify the MiFID or MiFID-related regulations so that the profiling is somewhat simpler and the customer is interested in the rate of return at the end of the day. Okay, I need to comment on that. When we were speaking about the MiFID questionnaire, I was really tempted to raise that. Many customers don't know why they need to complete it. Many people look at it as a kind of an exam that they need to take. But people do not understand that this is not a test. Well, I was almost touched when the representative of the regulator mentioned the need to modify MiFID. When MiFID I was enacted, remember? I can tell that after 2008, the American market was able to bounce back after the crisis fairly quickly, and the European market was staggering. And in my opinion, that was one of the reasons. So obviously, we need to care about the customers, and we have to protect them, but that's not really the way we should do it. Okay, so if I were to ask about anything, I'm looking at the PFR on my left. So perhaps we should review the regulations so that all the funds that we have in Poland have liberty to invest in the investment funds, so that we can have an investment fund in Poland. I mentioned all the types of funds because the requirement of the daily valuation is a major predicament, technical hurdle. I fully subscribe to that. I think that the work is underway to do something to enable the long-term funds to invest in the private market funds in the long run, not just into the publicly listed instruments. This is one thing. And Professor, I have one piece of legislation that is close to my heart. This is the statutory law on the investment funds. This law was developed many, many years ago, and I think that it's time to rewrite it from scratch. Because I think that it was adopted in the early 2000. At that time, we used to have a commercial code, and it was replaced with the Code of Commercial Companies. And this new Code of Commercial Companies was written from scratch. And it was really a boost to the market. So that we could take an example of that. Yes, sometimes it's easier to actually write something from scratch instead of doing the patchworks of many, many revised laws. Meanwhile, I looked up Slido, and there were some comments, but they disappeared. But I think that we actually responded to that it was not really about knowledge, it was about financial awareness. So that the government should really promote the willingness to promote your future wealth. And obviously, when we broadcast all financial scandals, that doesn't help the process. But when we keep saying that the KNF is always vigilant, it certainly does the job. Thank you. Well, thank you so much for this debate, very lively debate. Now it's time for the wrap-up session. I think that co-organizers will do the honor. Professor Łukasz Hart, the advisor to the chairman of the Financial Supervision Authority. Thank you. Well, I understand that the time is up, so no time limit, but I know that it's late. It is really hard to sum up such a seminar. So many interesting things. I did not agree my summary with Professor Pawłowicz, but Professor Pawłowicz inspired me with his historical reflection. He went back 50 years in time, but I will actually go back 200 years. And I will look at the work of my colleagues from the chair of the economic history of the Warsaw University. And let me quote from the publication of an excellent economist and historian, Professor Koryś. And here I quote, "During the past 200 years, the vehicle for the development of the Polish economy was industry development that was very labor consuming. We were trying to replace that with capital. We didn't have enough capital, but then we had regressions. Twice we had a war, and then we were not able to maintain the model. All the attempts were failed because the investments were not supported by the change of mindset and upgrade of skills and competence." I really recommend this reading to you. This is another type of history, economic history, very interesting. We are at the very particular moment right now. Our project, our modernization project is really coming to a certain milestone. We are truly close to the economic core of the West. Through our modernization efforts and system transformation, our productivity was growing faster than the wages, but that has come to the end. So we need to substitute labor with capital. And this is what Chairman Jastrzębski mentioned at the opening. Professor Koryś said that during the past 200 years we didn't have capital. Today we have capital, but it's misallocated. According to various estimates, 60 to 80% of Polish savings sit in the bank accounts and are invested in the real estate. So when you look at the economic history, I recall Marcin Piątkowski's book about the Golden Age and the history of Polish economy until 18th century. And he said that we were very inefficient fiscally, but there is one more thing. Look at the 18th century. What was the main investment vehicle? Land. And the Western Europe was investing in industry. And now what is the Polish middle class investing in? Real estate. What is the UK middle class or French middle class or German middle class investing? Capital markets. So it's important to draw conclusions from that, so that our savings are better allocated. I think that this change will be very difficult to orchestrate. I don't really want to go into the theory of political economics, but we would have to go through it to understand why the Polish elite and Polish political parties are well aligned when it comes to this item, namely tax privileges given to the real estate. Long-term inertia, so to speak. Look, we've heard from IMF representative that this is not rational given the challenges that Poland is facing. So if I'm invested in the real estate market, I reinvest my profit, I don't pay taxes. But if I invest in the capital market and if I have profit, I have to pay taxes. So tax regulations really offer privilege to the real estate market. This is my personal opinion. Mind you. Now, a few things that were mentioned here. I believe that we have a consensus here. Again, IMF, in their report last year, they said an important thing, that Poland was successful in their convergence to Western Europe, but Poland is badly needs the new growth model. And I believe that all of us agree with it. Now, investment rate. I have to say that I didn't understand many of my colleagues who, for many years in the public debate, were claiming that there is a dramatic problem of the low investment rate. Let me say something controversial. In my opinion, it was not the real problem of the Polish economy. If that was the problem of the Polish economy would be never growing that fast over the past 20 or 30 years, without getting into the details. We've heard the details during the discussion. Now, as I said, it was not a barrier to growth, but it is starting to be a barrier to growth, given the demographic crisis, given the lack of migration, because of other reasons, non-economic. We need to invest more. And I think that there is full agreement on that. We had a number of ideas, project bonds, the possible options for the National Bank of Poland. Now, in terms of the rate of investment, it's important. There is a consensus about it. And it was not said, but I do have some doubts. The economists claim that we may not be quite correct while calculating our investment rate. Please note that over the past few years, the inflation of consumer goods was much greater than the inflation of the investment goods. It seems that the investment rate is underestimated, even by 1.5 or 2 percentage points. But that's perhaps a topic for another more technical discussion. And I know that the National Bank of Poland is covering that in their research. One way or the other, the investment rate continues to be low. In 2023, I have such data. The investment rate amongst private companies in Poland was 9%, in Czech Republic 16%, in Sweden 16.9%. And this is the true measure of challenges that we are facing. And on the final note, obviously there are many other things that have to do with the stimulation of long-term investments. We've heard about the mortgage bonds or covered bonds. That's good. This is also something that is covered by the mandate of the Financial Supervision Commission. And there is also another thing which goes beyond our mandate, and this is a banking tax. And as you know, the Polish banks and the Polish banking sector has become the sector of investment banks. But this is not good because they have more treasury bonds on their balance sheet than loans offered to companies. So the question is whether it should be addressed. And finally, we heard a lot of estimates from various research institutes. I recall the estimate of BGK that was looking at our defense spending and energy transition, and they claim that it would take 1.5 trillion zlotys over the next few years. That's how much we need to invest. And that cannot be done with the public funding only. We need to have private investments. And therefore, the capital gap truly matters here. And we need to really figure out what we need to do to make sure that the private investors are interested in it. So finally, let me share another meta-reflection. Very soon, we are going to have another seminar about the 250th anniversary of Adam Smith's publication, and we are going to have a debate about Smith. And John Stuart Mill said once that the economy is too important to leave it to economists only. So when I was listening to the questions here, why we have such a low investment rate in Poland, I thought that this question should be also asked to non-economists. So perhaps we should also bring social psychologists and anthropologists to our next seminars, because the low propensity to invest or low elasticity of demand for investment products is really the true picture of our mindset. But we have the work of the social psychologists who claim that there is a generation transfer of trauma, which is much more relevant for Poland than other countries in Central Europe. Let me thank you, and I would like to thank you on behalf of Professor Jacek Jastrzębski, our chairman, who was not able to attend the second part of the seminar. I would like to thank the European Financial Congress and International Monetary Fund. We are truly happy that you joined us last year and this year, and I would like to thank you everyone who participated in person and online. And let me turn the floor to our co-organizers. I understand that the representative of the IMF and then Professor Pawłowicz.
Good afternoon, ladies and gentlemen. I hope you can hear me well. Let me start by sharing a little secret with you. We, as International Monetary Fund, a rather conservative institution, we always prepare very well to all the public speeches, and we very rarely present when we are not fully prepared. Each speech, each presentation, a lot of people work on it and analyze it carefully. And now I will be spontaneously commenting on this great discussion and about thing that surprised me. We talked a lot about PPK, and we, as an institution, I want to agree with everything that was said about PPK. I think it's a great instrument that helps all the saving instruments have to fulfill 4 criteria, and I think we will all agree what those criteria should be. They should be mainly cheap, diversified, transparent, and well regulated. We think that PPK is not far from the closest, actually, to those criteria. I'm very glad that Director Rywka also mentioned the so-called home bias. We do not love it as an institution. We think that if we want to provide some profits to the person who is saving, then home bias is not a good thing. In the speech of Carlos, we wanted to place Poland in the European context, and we also understand that the discussion about the investment union is not so popular in Poland, and we know why. But what we want to say to you is that we want to encourage you to follow the discussion in Europe. Europe is in a difficult position now, and we think that there might be a breakthrough moment, and the discussions that are carried out in Brussels and in other member states currently, they can lead to some big transformation, and it would be good if Poland was participating in it, or at least knew where they are heading. I also have to admit that I was relieved when I heard the director saying that, mentioning this European project. And the last thing, surprise, let me refer to the speech of Carlos. Well, he was talking about the disproportion in treating in the attitude towards investments in real estate and versus capital market. It was also mentioned by the professor, so I was really glad to hear it. It's definitely a topic that Poland will have to face sooner or later. Because if we want to increase long-term investments, and we think of a capital market as a time machine to support it, as a vehicle, there is no reason for the real estate to not have those conditions. And I would like to also thank you for inviting us to the seminar. The discussion was really very interesting and well organized. I also wanted to tell you that as an institution, the heart and brain and mind of the fund is in Washington, and here in Warsaw we have our small regional office that is very active. So we encourage you to contact us. We are open to discussions, and we are very glad that we could participate in this discussion today. Thank you. Thank you, Maciej Janoszko, senior expert for communication, International Monetary Fund. I'm sorry that I didn't introduce you in advance. And now Professor Pawłowicz as the last one. So you have the last word. I wanted to thank everyone who made it till the end. I would like to thank my previous speakers and the organizer who was the host, who was hosting this whole event. I will refer to the historical thought of Professor Hart. I will move half century to the past. Indeed, we cannot give the economy only to economists, and let alone to lawyers. But I'm wondering who actually supported the implementation of the market economy, and I think it was Jacek Fedorovich, my favorite comedian. 50 years ago exactly, he received the award of the Polish radio and television for his cabaret show. And then he was making fun of the centrally planned economy, and I think that he really had a strong contribution to the situation during the first years of the transition. And I wanted to say that what we discussed today, there are a lot of different ideas. I think that all of those ideas complement each other. It's not that one is better than the other, that KPO is better than domestic savings. KPO is just 60 billion euros, a little less than the savings that we have in commercial banks in the National Bank of Poland, but they complement each other. Also, what Rafał Kozłowski said, and he was right, because no project finance would be favoring the assets, state assets, as a better warranty than the warranty of KUKE. This is obvious, but from the point of view of KUKE itself, if in the target company that is founded by the owners of the company of the president where he works, if they start this company, let's say for energy storage, and in this company where they plan to build those warehouses, if there were some state assets, it does not exclude the warranties of KUKE, but then KUKE would be willing to give the warranty. Because when we talk about investors, it's about not waiting for the court to judge how to share the money in the case of bankruptcy, and we have to take a few years before we have the decision. No, KUKE will pay out the insurance immediately, and they can wait for the decision of the Polish justice. So it also complements one another, and I think it's a really interesting idea. And there was a question, but I didn't know. I had to check what are what is the security of the Polish Center for the Agricultural Support. This is 1.9 million hectares that were left that are like state assets which are leased partially, but they are part of state assets. So it's just my thought after the debates that those ideas complement each other. And I think that we will continue in that direction, because also the cooperation between our three institutions creates such ideas. I'm inviting you to continue the conversation during the European Financial Congress in Sopot at the beginning of June, so save the date. You will receive official invitations a bit later. Thank you very much. So I can just say that the co-organizers of this seminar today were European Financial Congress, the Financial Supervision Authority and International Monetary Fund, and the patronage was taken by the mentioned entities. Thank you very much for the meeting today. So let's meet in Sopot, or let's meet on the next seminar about the risk and regulations. Thank you.